Welcome to Umbrella Saturday webinar. My name is Ayola Ogunyomi, and I just take you through some of the documents that we have. Umbrella Saturday is a high-impact weekly Zoom webinar. We're going to have a series of it hosted every Saturday in the month of May, and we'll do this all through the year. Just trying to learn how we can pass, knowledge to founders, as well as bring some of our partners on board. This is also an avenue for investors to also do some deal sourcing. Just getting to know the founders one-on-one. That's our identity. Just a few things about myself. My name is Ayola. I have over 14 years experience in branding, marketing, and also building businesses. I've worked across a couple of industries and sectors, a couple of businesses as well, just growing people, growing brands, and growing businesses. I have also been an entrepreneur, a founder at like. Just to let you know that I'm also a founder. So who is this seminar for, or who is this webinar for? Basically for founders who are seeking clarity, mentorship, and access to the real world of expertise. Investors who are scouting high quality verified African startups. So of course, that's what we do at Umbrella. Of course, ecosystem advisors and operators, people who are looking to share knowledge, right? Partners who are looking to share knowledge and also stay engaged with the latest innovation. And of course, corporate partners and brand who are aiming to position as an innovative leader and gain proximity to the next generation of disruptors. What's in it for you? As a founder, there's a lot in it for you, right? Access to industry expert and actionable insights. Of course, it's a free platform to pitch your ideas and receive live feedback. Exposure to investors and key ecosystem players. For investors, of course, is a direct channel to connect with verified investment-ready startup. Early access to deal flows and, of course, sector-focused conversations to match your thesis. And then, of course, for the speakers and advisors who will be joining us over the next period, of course, visibility among African emerging markets or founders and talent. And of course, the opportunity to influence the startup thinking and direction. And of course, partnership opportunities with Umbrella as a platform. Why must we be a part of the Umbrella Saturday, right? Of course, we build trust. And of course, that's what we do at Umbrella. Umbrella is built on trust. And of course, we help with curation. Part of the things that we do, of course, from all the speakers to the startup to the content, we vet. And of course, we also put out quality. We're founders first format. Of course, every session is designed to prove and provide real value to the founders, from insights to investment, and of course, consistent deal flow. We started the Umbrella Saturday so that we can consistently have a deal flow. Each webinar serves as a soft demo day, giving investors regular access to created startups. What makes Umbrella different? Basically, we're community powered and data driven. We're verified pipelines of startups across Africa. And of course, we have multiple stakeholder experiences that will be coming to share things with founders. This is not just another webinar. It's, of course, Africa's most reliable digital gateway to early stage deals sourcing, expert insight, and of course, startup investor matchmaking. So you're welcome to Umbrella Saturday. I would stop there and then go to the business of the day, where I would introduce the speaker. Today we have two very important people on the call, Mansi and Gunjesh. Mansi, I would like that you just take up the conversation from there. Do some intro about your business. I'll stop sharing my screen so you can have the screen. Do some intros about your business. Speak to the founders about it. They're coming all the way from India, and we like that we have similar marketplace. So we are happy to have you and Gunjesh on the call as well. I would stop there and then you can take it over.
Thank you so much, Ayola, and very gracious of you for having us here for the Umbrella community today. So I'm going to share my screen very quickly, and then we can start from there. I think you'll have to give me the access request. Pass on.
Access granted.
All right. Thank you so much. Let me know if the screen is visible to everyone.
Yes, it's up.
All right. All right. First of all, hello, beautiful people. Namaste from Team Intent, and a very hearty good morning to one and all. It's a complete honor to be in presence of the Umbrella community here with the cohort of startup entrepreneurs, VCs, investors, advisors, and developers here. And first of all, thank you so much for sparing out time for the conversation today on a weekend morning. It is really exciting for us to be here. And it is going to be an exciting session. Do you all feel the same energy? Like, feel free to just push your hands up whenever you feel like to speak. So I'll be more than happy to take it forward from there. So it's going to be books from Bucks today with Gunjesh and myself. Both of us, Gunjesh Jain and myself, Mansi Dixit, are the founders of the company Intent Fin Ventures, established in India, which is a fractional finance management company. Without any further ado, I'll go and introduce myself. I'm going to hand it over to Gunjesh as well for his introduction after mine. So, to introduce myself, my name is Mansi. You guys already know that. I'm a qualified chartered accountant from India. I have been working in the field of finance since a decade now. I started my career with EY in mergers and acquisitions, where I was doing the financial due diligence for the M&A deals. Then I moved on to JP Morgan Chase in corporate finance, and then to investment banking with Bankers Without Boundaries in London, where I was working in the sustainable and sovereign finance. I was given the opportunity to be the finance lead and mentor to a lot of startup accelerator programs worldwide, majorly in Netherlands, Fiji, India, and the UK. And I've led several of them as the finance lead and mentor, where I was dealing between a cohort of startups and a lot of investors in different industries. I came back to India when I thought that it is important for me as a chartered accountant to contribute in the startup ecosystem. And I started my own company, Intent, which is a fractional finance management company, which focuses on supporting startups and scale ups globally. We are prominent everywhere in the world: UK, Ireland, Africa, US, Singapore, Canada, everywhere. So this is a bit on myself and on Intent. I'm gonna stop here for a moment and hand it over to Gunjesh for his introduction, and then we'll move ahead from there. Thank you.
Yeah, thank you, Mansi. And hello, everyone. So, as you all know, I am Gunjesh. I am a qualified chartered accountant and the co-founder of Intent. Over the past decade, I had the privilege of partnering with startups and scale-ups across the globe, helping them manage their finances and become truly investment ready. My core focus is making companies investable, not just from a compliance point of view or reporting standpoint, but also aligning the financial strategies with the investor's expectation. Throughout my journey, I have worked with founders across different sectors, including AI, agri-tech, fintech, e-commerce, space tech, and more, and basically helping them in streamlining their finances, their finance function, and successfully raising capital. So, and to be honest, I'm really excited to be here today amongst all the fellow founders and change makers. So, yeah, looking forward to this conversation, and thank you, Ayula, for giving us this opportunity.
Thank you so much, Gunjesh, for your introduction. So, to start with, I will be leading this webinar today, the segment here. And then for the Q&A or any questions that you might have for us, Gunjesh will be leading the Q&A segment for us. So, let's move ahead from there in that case. So, to begin with, the first most important thing that I would like to discuss is why the conversation today matters. I'm pretty sure a lot of us must have seen shows like Shark Tank or Dragon's Den, where in your head you become the founder who are placed in front of the investors, and you play the game in your head that, okay, I am the one who has raised a lot of millions, and I'm the one who is the successful founder here, raising a lot of capital from the investors. I know I am also a little bit guilty of doing that myself while seeing all of these shows myself. But have you ever thought that there are a lot of founders in place who have great ideas, great products, but they fail to raise the funds for themselves? Do we actually think about what is the reason for it? Is it because their educational background is not that good? Or is it because they have a niche market range that they are targeting? Or is it because they have complex product that they have developed? The answer is none of them. 90% of time, so there is only one reason that they fail to fundraise, and that is no financial clarity. Before the capital comes, there should be a clarity about your finances in front of you. The founders who are actually tight with their numbers, they know their numbers, can actually write their own term sheets. That is the truth. And nobody actually likes chaos, confusions, or complexities. Like no investors like this, and they do not get the valuation that. So when your numbers speak, the money doesn't just listen, it actually comes back to you. And for blooming startup ecosystem, like for African startup ecosystem or for Indian startup ecosystem for that matter, the only way that you can stand tall in front of the global stage is having the financial clarity. So let's start from there then. I love storytelling, by the way. So let's start with the story first, and then we'll go into any kind of technical stuff, right? So the story goes like this. There was one startup which was built in Lagos. It started in 2016. There was a brilliant team of engineers that has built a revolutionary payment system which can connect the African startups to the global world. Their technology was exceptional. They were processing 1.2 billion transactions in 1 year. The people, the customers were loving it. They were going gaga over their products that they were working on, right? And now the founders thought that they are now ready to go a next stage and fundraise for themselves so that they can go to a global market, right? So they started meeting investors in Lagos, London, San Francisco, and different parts of the world. And this is how their first conversation went with the investors. The investors asked them a few questions around their business. For example, what are your contribution margins? One of the founders said, we are actually processing millions in volumes at the moment. Another one asked, what do you mean by the customer cohort retention in your business? The another founder was a little bit hesitant understanding what they are trying to ask. And then he said that, okay, we are adding new merchants on a daily basis in our business. The next question was, your revenue recognition seems inconsistent with your transaction volume. Can you please explain? Both the founders were baffled and like they just said that, okay, we are going to send the updated numbers next week to you. The thing is, the meeting ended with a polite smile, but there was zero capital raised in after this conversation. The founders were utterly confused. What happened wrong here? Like they had genius product, the customers were loving it, but why were investors not seeing it through them, right? Then came a turning point where one of the senior VCs told them that your solution is brilliant and your finances are a black box. And I actually cannot invest in a company where I cannot measure what is happening in the financials. So the story does not end here. The founders took another 6 months to understand what's happening in their finances. They put up a system in place. They had their reporting structured, formatted. They mastered the unit economics and they came back again after 6 months for a fundraise round. Now they had a better clarity, and that came with a lot of power of understanding what was happening in the business. They went again for the second round of investment, and now their conversation went in a different direction. Now they started saying that the contribution margin looks like this, the pathway is 2.3% at scale, the customer retention rate is this after 12 months, and this is going to increase in volume in a year too. Our company follows IFRS standards and it is audited quarterly. Now, do you see what is the difference between how they presented their finances in both the situations that they were talking about? This time, the term sheets appeared. For Series A, they raised $10 million. For Series B, they raised $35 million. And of a total of their lifetime fundraise, they raised $470 million funding. Can anybody in the chat guess what is this company and have they ever thought about it? Anybody, please go ahead and go ahead in the chat and comment if you know this. I'm gonna wait here for 5 seconds. 5, 4, 3, 2, 1. Anybody?
I think we have got the right answer in the
Okay,
chat
great.
from a
The
few.
company is no one else but Flutterwave. Flutterwave was the company which was founded back in 2016. They raised a total of $470 million. The business valuation of Flutterwave at this moment is $3 billion, and the operations are more than in 50 plus nations around the world. We have seen this transformation in front of our eyes, and this is not something that a story that I'm telling out of the blue. This is all in front of everybody, in front of Google. You guys can go and Google yourself if that feels correct for you. The moral of the story is not how Flutterwave did it, but how many of you guys can actually recognize the part of your own journey in this situation that we were talking about. You have a brilliant idea, you have a brilliant innovation, but there are some gaps in the financial rigor. The truth is, managing accounts or managing finance is not just for tax purposes or not just for pleasing any investors. It is much more than that. It is of A, building a sustainable business, B, seeing your company very clearly, and C, and most ultimately, transforming your brilliant idea so that it creates a lasting impact in anybody's life in the world. Now, some of you may ask, where does everything of this miraculous transformation starts from, right? The answer is very simple. It's the humble bookkeeping or your books of accounts that we talk about. No one, and mark my words, no one has ever put their pitch deck successfully in front of the investors until and unless they have managed their books of accounts very, very smoothly. Your question would be, but how? How? The worst preconceived notion that any founder can have is bookkeeping or managing the books of account is just data entry. Just for your reference, it is not that. It is actually tracking every penny that your business is making. How are you utilizing it? Categorizing it into incomes and expenses, and making an understanding how the cash flow is actually going on. If you understand the basics correctly of keeping your books of accounts, the foundation for all the financial decisions will be driven from there and from nowhere else. So most of us have actually seen these shows where we see a lot of jargons, CAC, ATV, etc. Right? Have you ever felt very anxious listening to all of these complex jargons and technical terms that we are talking about, or the KPI terms for that matter, be it CAC, LTV, burn rate, GP rate, DSO, etc. A lot of them, right? Everybody feels really anxious around it. Nobody wants to understand what it is. What if I tell you all of this is nothing but the analysis of your books of account. If you keep your books clean, crystal, and transparent, all of these analysis can actually be done from there itself. Be it your core financial statements, profit and loss account, balance sheet, cash flow statements, be it your records or ledgers, be it your reports of accounts payables, accounts receivables, bank reconciliations, be it your revenue operations or expenses details, be it the reports around them, be it the detail around tax or statutory compliances, details around your fixed assets, etc. All of this is actually just a part of or the extension of the bookkeeping or the books of accounts. When I was talking about the jargons that we were discussing before, right? All of this is nothing but the analysis of the books of accounts. When you prepare these strategic reports, out of the transactions of the books of account, they turn up into these KPIs and terminologies, which usually the investors ask, right? From the reports like books, like budget versus actual report, forecasting sheet, burn rate, runway projections, anything of that sort, all of this comes from one source, that is the books of accounts. In short, the only thing that I can say, if you want to start to have a grip on the financials, you can start from here. Every KPI, every terminology, or any parameter that we talk about is actually just the analysis of our books, nothing more. Now, some of you believe that all of this is fine. This is okay. I still believe without all of this fluff of bookkeeping and like talking about all of this bookkeeping drama, I can raise funds from the investors. I'm pretty confident of that, right? Some of them, not all of them. Sorry. So somebody can think about it, right? So let's play Shark Tank live right now in front of everybody. I will take you through the pitch deal room and let's see how the scenario looks like if you go without any books of accounts understanding in front of an investors. How does it look like? So now you have taken your product or your service in front of an investor. They love it. And now they will have some questions for you around your business to understand a little bit more better, like how your business is actually doing, whether or not it is feasible for them to invest in your own business, right? So they're going to ask a few questions which are really like around your business. Like, for example, what is your addressable market? That is TAM, SAM, SOM. What is your burn rate? How is your cash flow runway looking like? Have you prepared your budget and forecast? Do you have the understanding of MRR, ARR, etc.? How does your customer acquisition cost look like? How does the churn rate look like? How does the customer lifetime value look like? Now, anybody who does not understand what's happening here, what are they asking? The situations are going to be two here. First situation is going to be, all of this is going to sound like an alien language to you. And you will feel that, okay, I am not able to comprehend what is happening. And that's why you cannot answer what they are asking you. The result will be, there will be zero fundraising, there will be no fundraising for you. The second situation can be, you know the answers, you know what they are asking, but you are not trying, like you are trying to put it in words, but you cannot because you do not know what should I put it in front of the investors. The result is going to be the same. There's going to be zero fundraising, there's going to be no fundraising, because you'll have to present in a language which investors or the people who want to know about your business understand, right? So there will be a few people again here, the smart lads in the people that we are talking about, who will think that I am a smart lad. I can remember everything around it in my head. I still do not want to keep into the books of accounts drama anymore. And I want to go ahead. I will remember everything in my head. You will see, like every question that the investors will ask, I'm going to answer that all along. So let's see how that situation looks like. Now the investors are going to ask all the same questions. You, the smart lad, are going to answer all these questions. The investor is very impressed. They feel that, okay, this is a great investment that they are making, etc. But before making any investment, they're going to call out their financial due diligence team who are going to check whether or not what you were telling to the investors are correct. Because why should one believe anybody what they're trying to say unless they have any proof of it? So they're going to go ahead and check your books of accounts, your records, your reports, which will give the answer to whether or not you spoke correctly in front of the investors. And if you do not have that correctly presented, forget about raising even one penny, even after you were smartly presenting your answers in front of the investors. So the difference is very much in front of you. You do not even not only have to speak in the language where people understand your finances, but you will have to prove it that what you are trying to speak is in front of you in terms of your books of accounts. Very simple like that, right? Moving on from here. Now, I know in this cohort of audience, there are different founders who are sitting. Some of them are at an idea stage. Some of them have raised some kind of seed funding and like they've started their business. Some of them are at a growth stage. Some of them are trying to raise more funds. They are pre-seed, post-seed, etc. Right now, everybody have the same question in their head at this moment. I'm pretty sure. Like, is everybody needed to maintain similar kind of finances everywhere? Like, is my company also liable to prepare such complex models? Like, I have just started my business. Like, what do you think? Like, what is the notion there? The answer is no. With different milestones, there will be different requirements that one has to fill, right? For example, when we talk about the first milestone, the investor type usually are the angel investors or the friends or family who are sitting there, right? The financial requirement at that time will be the basic model, the clearer books of accounts maintained, or the estimated budgets or forecasts of any business. When you move past that and you move into a second milestone where you have become a little bigger, you have like actually showed up that your idea is actually workable. The investor type at that moment will be pre-seed VCs or the VCs. The financials at that moment required are milestone 1 plus the burn rate, the CAC, deeper forecast, other KPIs, etc. When you grow a little bit more, everything in milestone 1 and 2, including some of the revenue models, gross margins, unit economics, other KPIs will come into place, right? Now the investor type will be seed investors, private equity, impact investors, Series A raised, etc. So now your organization has grown to a limit where you are now looking at a place where you want to scale your business, right? So now comes milestone 4. Here, the presentation of financials will move into a little bit more complex and detailed level. The investor type would be Series B or plus. The family offices can be there. There can be private equities or the VC boutique firms, etc., who will look into full audit, cost control, and financial strategy for any business. Now, one point to think about is all of this analysis cannot be done by one professional. You would require different professionals to do different kind of work at different stages of your company. Sometimes a bookkeeper is enough for your business where you are at a very idea stage kind of a place. Sometimes it is the finance manager who is required to maintain your strategies, to maintain the overall system implementation, etc. When you grow a little, fractional CFOs or virtual CFOs are somebody who would be needed to like handhold the overall finance function for you, to represent the finance function in front of the investors or the board, etc. So there are different requirements of professionals in different stages around that. So one actually cannot jump to the ladder of fundraising starting from day one. I've seen so many startups while I was working with the startup ecosystems in the accelerator programs, where the first thing that they say is, I need to raise fund because that is the only reason that I will grow, and that is the only way that I can grow my business, without even thinking that whether or not their business is mature enough to raise the fund and whether or not they require that kind of fund to process their business further, right? You need to follow the baby steps to go to the fundraising level one by one. So what can one person do to achieve that kind of a level where they can be investment ready? Start with bookkeeping. Move on to the monthly reports after that. Start seeing what's happening in your business through the reports. Start preparing the forecast after that. See what your business looks like after a certain point of time, be it annual, be it monthly, be it weekly, whatever you feel like for your business. Start working on unit economics of your business after that. Once that is done, make yourself a little bit more savvy in terms of your strategic finance, how the overall finance function is working, how the business is being impacted by your finances, how strategically you can manage it in the best way. And then you will be a little bit better fundraising ready for your business. Now, if everything was so simple and everything was so straight, why would anybody struggle this much? Why would founders not like manage everything instantly? Because this is not something that I've talked about, which is rocket science here, right? This is very simple. Everybody knew about it. This is just something which I'm putting out on the plate. But having heard a lot of startup conversations, having been with the founders a lot, I've heard them talking a lot around um, like how they are maintaining their businesses, right? Most of the conversations are always around product development, marketing, exports, imports. Finance is the least prioritized thing that they talk about. That is the least spoken about, right? But this is not something which is very much regional specific. This is a global phenomena which is happening everywhere. Nobody wants to give something of a sense of finance, which is a boring thing, some kind of attention. Other things are more important for every founder for that matter. And these are the valid reasons that I've heard legitimately from a lot of investors, from a lot of founders for that matter. First, finance isn't my thing. To answer that, you'll need to talk, as we discussed, you will need to talk in a way that anybody wants to understand your business or investors want to understand your business, right? Avoiding this will not help your business at all. Second, CFOs are costly, bookkeepers are basic. Now, this is the dilemma which I have heard from numerous number of founders and startup product developers. And I would say this is quite true. This is true. But let's discuss this in the next slide itself, the very next one. So let's keep it on hold for that moment. Third one, I know the numbers in my head. I will not speak more around it because we have already seen scenario 2, where what happened when you keep number in your head, but it needs to be presented on the paper for that matter, right? Fourth, we'll do the bookkeeping when it is needed. I would suggest if you speak this in front of an investor, see your credibility burn into ground at that moment itself. So do not do that, right? Fifth, accounting retainers and fixed costs are bleeding us. Now, again, that is also true. I would not say that this is not the correct thing that they are saying, but let's keep on hold for the next slide that I'm going to show you guys, right? And the sixth one is because finance is not a revenue generating function for my business, it doesn't make money for me, I would not invest in it. The thing is, whether or not finance is a revenue generating function, it definitely drives your revenue. So do not think that you can leave finance alone and you can drive a better product without the finance. So it is something to ponder about for all the founders out there. So I know I've covered a lot of things that you guys already think about, but I believe there can be a solution for all of this. And let's discuss this in the next slide. Before I discuss what my solution is that is in front of you at this moment, fractional finance, I would like to tell you a little bit of example of before moving to this, right? All of us must have heard about a company named as Unilever Limited, right? It is an FMCG giant, and it operates all over the world. Usually, when Unilever Limited had its shampoos, detergents, etc., when it was sold in the US markets, it was always sold in a bigger capacity, 5 kgs, 10 kgs, etc., because that was the purchasing capacity of the US markets. But when they decided to come to the African subcontinent or Indian subcontinent for that matter, they started selling it in sachets or smaller packages, right? Because that was the need of the geography. That is how the people wanted it to be. And also, that was the purchasing capacity of the geography they were trying to cater. And believe me, they won there. Otherwise, if they would have kept the 5 kg, 10 kg packages here in these nations, it would have been really difficult for them to like cope up with the market, right? Now, why I was telling this to you guys? I was telling this to you because today also the traditional finance is packaged in the 5 kg package, and nobody thinks about what if the people do not want a heavier package? What if they want something which is more convenient and flexible? So that is what fractional finance is. Fractional finance is a flexible need-based model where you can take whatever service you want for your business, source from professional CAs, ACCAs, or CPAs, and compensate them only for the days that they have worked for them. There are no fixed costs involved. There are no retainership fees involved around it. Now, finance can actually be capsulated into a smaller sachet or a smaller package now, right? For example, usually the CPA firms or accounting firms, the offer that they give to anybody is like, okay, we will do everything, the 10 things that there are in a package in a monthly way, and we will charge you certain bucks. But what if one organization does not require that for the whole month? Still, because they do not have the answer to it, they will go ahead and buy it, and that will cost them a lot. Or if you say that, okay, I will hire somebody internally to do bookkeeping, to do managerial work, to do the fractional CFO work, it's going to cost you 3 times the cost of people. And believe me, a finance of a startup does not take more than a week to process for a whole month. But still, you will be paying salary of 3 people for the whole month just to do the work of 1 week. That's how we are simplifying the finance now with fractional finance that we are talking about. Now you will say, like, why fractional finance? The thing is, there are different companies, there are different industries, and for every company, the structure and complexities are different. Their requirement on a particular month are different. You cannot say that you'll have to take a batch of things every month and this will fit everyone. No, it's not going to happen that way. Accounting and finance need of every business is going to be different. So one mold actually cannot fit all, right? One business might require 4 services out of 6. Another business might require different kind of services, 3 out of the 6 services. And the third business just want everything, leaving 1 service. Now you cannot say that I'm going to give you a package of 6, you'll have to take everything, right? It is hefty on anybody's pocket for that matter. Startups feel a little bit more burdened that, okay, I'll have to take so much of package to work around the finances, rather leave it alone. Rather, if you go ahead with fractional finance, you can save your time, you can save your efforts, you can save your money around it. And to know more, like how that can be done, you can actually connect with Team Intent, who is working in and out to support the startup ecosystem and scale up ecosystem today, to help the founders in a way where they feel that, okay, this is something which is flexible, this is something which is economical. Whenever I feel I can like take this kind of support, be it as small as bookkeeping, as big as of a strategy management from a manager, as big as a fractional CFO kind of work. We do everything and anything for these startups with intent. So I'm going to pause here for a moment. But before I wrap up the session today, I would just like to close the session with a small note that usually the founders or the startups don't fail because they are not able to raise the funds. Rather, they usually fail because they lack the financial discipline and foresight. If you master the metrics, if you have that kind of support, the money will follow eventually no matter what. And in this journey, intent is going to be there with you for whatever requirement you feel like, and we will support you in that manner. Thank you so much for your patience. And you have been a lovely, lovely audience. I'm going to stop here for a moment and I'm going to stop sharing as well, coming back to the screen.
Thank you, Mansi. Right. I was just going to jump right in there. In Nigeria or in Africa, we've seen startups that have raised even to serious funding, right? And they're still shut down, right? What would you say is it also part of financial discipline, right? Because part of what you've said now, which is a keynote, something that should be on the walls of every founder in his or her office, is startup don't fail because they lack fundraising, but of course they fail because they lack financial discipline. Do you want to just speak or touch some lights into
Absolutely.
this reason
Absolutely.
from your experience
You
fundraising?
you said it very correctly, Ayula. I was actually working with one of the startups in Africa, and like I would not take names here, but they have raised Series B, sitting in Nigeria only. And I had a word with their CFO where I just thought I was just randomly talking about their financials, how things are happening, and the CFO just took over the role a few months ago. The CFO was frustrated because of one thing, that every month that I want to see the previous month's performance, the numbers keep on changing. The numbers were not consistent for the previous months as well. What does that mean? It means that nobody can actually rely on what you're putting down in front of the investors for that matter. Even if you raise so much of a money, someday it's gonna crash down like anything because you do not have the insight of what happened, what is happening, how you can actually mold your financial decisions around it. So this is coming directly from the horse's mouth, as you say, that it is coming directly from the CFO of such a big company that has raised Series B. And I am pretty sure that most of the people here will know the name of the company if I say that, but I'm not gonna. But this is the truth, and I've seen it bear eyed. And I believe if smaller things can be taken care of from day one, that can actually be transformed into something which is a good financially disciplined company, and the life will be easier for everybody, not only the founders, the accounting team, the products, the marketing, etc. Everything actually will run really smooth if this is actually taken care of. So I'm not sure if I answered your correct
All right, that's
question
fine. There's
correctly.
also something else I want to bring to the forefront, right? Again, we see that very early stage startup usually do not separate finances of the founders from the business, right? And I don't know if this is also practical in India, but again, this is, you start to set up the accounts when the agreements with the founders are already in line. For some startup, the money is coming from the founder's pockets. The funds goes back to the pockets. It uses the pockets to feed the families or the responsibilities that are personal. And good Jack, I can see you want to speak on this as well. But this is what we see in the ecosystem that we play, right? Even when they are even at the stage of fundraising or they've been funded, we also see that founders still use investors' funds for personal needs. Do you want to just speak to this and how this fractional CFO bids puts a bit of structure to founders in Africa?
Definitely. So I would be very happy to cover this. And you are saying a very bitter truth in this. And so this has been the case. And to be really honest, Avila, this is not just the case with, for that matter, African startups or Indian startups. And it is definitely not restricted to any geography. I mean, we have worked with startups across different continents, different countries, and have seen the same thing. I mean, to give you two examples here, we are currently working with a few startups, as you already are aware. There is one company, AI tech company, Ireland-based, very big company, have raised funds. They are on point in their reporting. We manage their finances end to end. They are very, very on point in their reporting. Nobody takes a single penny from company when it comes to, spending out personal expenses and everything. And I know another company, which is a UK based, it is again a good company, e-commerce based company. The founder is really smart, but the only problem with her is that she's not separating out the investors' money and her own money. Now, the real problem is not basically utilizing investors' money in paying your expenses or whenever you have excess money, you just put up into the company. I think the real problem comes from when you are not valuing your time into the startup. So what usually happens is that founder is working dedicatedly, like 15 hours, 20 hours a day, and putting all the efforts that are needed, but they are not getting compensated even when the startup is funding. If that's the case, then founder has to go to the company and take out his personal expenses and everything. Ideally, what should happen is once the company is established, once the company is has received the fundings, ideally the investors, so the founder should value his own time, take out the salary of his own time, do his personal expenses from there, and the business and founder should be two separate entities, and that's how the finances should be managed. So yeah, I mean this has been a problem across the globe, but yeah, there is definitely a solution to address this.
All right. So before Jude takes the mic, I'm just going to quickly point like something where and that goes to you, Mansi. You can also speak on this. When founders hear when the company is established, it means that when the company starts to make a lot of bucks, right? We're speaking from books to box here, right? When the company starts to make a lot of money, that's what established means. When I say, you guys are established, it means that you guys are making a lot of money, right? For a startup at the early stage or at the ideation stage, it's not established. He doesn't think that he should start putting those structures into place. And part of the things that we want to do on this call is to be as honest as possible. Let's have honest conversations. At that stage, I want to run a business. I'm focused on the product. So, Mansi mentioned along the line, founders are focused on business, marketing, growth, operations, technology. Finance is just what comes as a bythought. How do we address this? Mansi, Gunjesh, anyone? You can go. And then Jude, once you're done, you can take the mic. Yeah, go ahead.
I will go ahead here and speak. The thing is, everybody takes the consideration that finance is something that will take a lot of time on their end, and that will take a lot of money from their pockets. This is a preconceived notion from everybody's end who think this will take a lot of time, or this is very complex. I have to coordinate with the people that who are doing. Listen, the thing is, there are professionals who do it in a very seamless manner. This is not heavy. We do it for companies who are at a idea stage, who cannot even afford to go for a simple software or accounting software. We do it on Excel for them. There are companies who want it a little bit more automated. They go with softwares like Zero, QuickBooks. Then for data visualization, they go for Power BI, etc. The companies think that this is the biggest scale is something that accounting is. It is not. It can be as small as preparing an Excel sheet where you are managing everything in a correct format way, and where you can actually answer your questions of how you are managing your accounts. If there is any incoming in your business, if there is any outflow from your business, if you just simply record it, this will actually make sense at the end of the day that, okay, what happened in my business? Until unless you think that, okay, this is something which is very complex, I do not want to get into it, etc., you are just closing your eyes and thinking that nobody is seeing you. That's not the case. The thing is, you'll have to keep it really open. You have to understand that, okay, if you are not the finance person, give it to somebody who is a professional in doing it. And it is not something which is a lot of economically burdensome for anybody's pocket for that matter. Gundesh, if you want to add anything that I said, feel free to do that.
Uh,
I'll stop here.
yeah.
Yeah.
Definitely. I mean, to some of these things you have already covered in one of your slide on when while you were speaking about at which level the startup is really important to understand what exactly their finance needs are. So as Ayula, you mentioned that yeah, for very early stage startups, even if they can keep very basic bookkeeping, even if they can do like a month on month, very basic structured of their cash flow forecast for the coming 12 months, that could even be sufficient for them because that gives a better visibility to them as well that, okay, I have this much of cash balance left with me. I can sustain for this many months, and I have a better clarity on this now. So I have to get my next round raised within this month. So this is the sort of clarity that exactly every founder needs. And this can be achieved merely with a very simple Excel sheet as well, along with a very basic bookkeeping thing. So that's the only catch to it.
All right, thank you. Jude, let's have your question.
Yeah, hi everyone. Good morning. Hi, y'all. Nice to connect with you again. Like seriously, I will say that. Um, very quickly, yeah. My concern, and rather, I would
Sorry,
like
Jude,
not.
let's do this. Let's do this, Jude. Let's just do an intro of yourself, the name of your startup, and then what you're building. And that also gives some context to how they can maybe answer it and it's direct. Does that work?
Okay, that's fine. All right, my name is Jude Chibogo. My business is the Arc. It's a poodle store where we are trying to solve the problem of logistic business in Nigeria and West Africa at large. We're looking to take it from the traditional way to a more automated kind of way because I believe in the Western world, logistics is on a different scale. And we've had issues with time, trust, and reliability in the current way logistics is run in Nigeria, and it's actually very, very big. Logistics is big, and we're looking to tap into that ecosystem. We are currently in our seed funding stage. The idea is there. We've tested the market. We're trying to create some MVPs and see how we can scale from there. Yeah, so that's it for the business at the moment. And I'm the co-founder. Yes, so my question, rather my concerns are regarding to this issue of finance. You see, for me, this is actually me coming into the entrepreneurship space as the founder. I've always worked with entrepreneurs in the past, and I've seen different entrepreneur startups, how they fail and why they fail. Now I'm in that space. I'm at the point where I feel like I'm running short of resources to actually actualize my expectation. I've created timelines and I've set up targets. But now I need to find a way to let this dream not die. Finances is a big concern, just like she said earlier. But what I figured is most times we don't think of finances from the beginning. We just think about the idea, what is solving and how it's going to solve it, and keep pumping in money and putting all the resources. At some point, you run out of resources and you're stuck. And that's when we start looking for investors. So my question is, at what point and in what hierarchy or in what order should one consider certain factors, maybe finance, idea creation, market strategy, MVPs, and all those terminologies? And how do you place them, and how do you break each stage? Because it's becoming a problem. Do you get? Because if I have this idea and I've tested the market, I've seen how it works, I should be making progress. I shouldn't be stuck. So what do I need to do at that point? I don't know if that question is clear.
It's very clear, Jude. Very clear.
Yeah.
Who is going on this?
Okay. I'll take this one. So first of all, congratulations, Jude, for such a great innovation, and you're doing a very good job on this. So congratulations for that. And then it is a really good question, to be honest. And I would like to extend the previous conversation we just had, that it is obviously very, very important to understand that at what stage you need which function to be working in your business. And as a founder, no matter what is happening around the business, the ultimate responsibility is on yourself, right? And not just you, I mean, on respective founders of the businesses. So that's where the things come from. So let's understand in this manner that, for example, when I get an idea of doing a business, I just see that, okay, I can purchase this in 100 and I can sell this in like $110, for example, and I can make $10 in profit. And because the market is so big, I'm gonna make like millions out of it. That's the very basic idea when a founder starts business. But the real problem comes when you have to understand that, okay, I have to manage the working capital as well. So when I'm investing, the money that I'll be getting back will be 3 months later. So I have to take the inventory in account as well. I have to take the trade receivables in account as well. Then I have to make the payment to my vendors as well. And ultimately, who is going to maintain that? So I think it is obviously it is very, very subjective for every business to understand where the finance function is important and how important is it. But from what I can say in a very basic language is that even when you are at a startup at a idea stage, I think you should be considering finances as one of the top priorities, if not the top. Obviously your product and your technology is your top priority, but you should be giving finance as a priority from day one. I'm not asking you to spending a lot of money from the day one, but at least you should be engaging with a very basic consultant who can at least guide you on the basics of financials. From there, you can start, and then obviously 6 months down the line, when the product is actually developed or when you're looking to raise money, you can ask them to build a basic model for you. Then 12 months down the line, 18 months down the line, when the money is raised, the business is doing good, you can go much deeper into it. So what I can say is that from day one you have to start, but then the scope gets bigger and bigger. That's the idea here. I hope I was able to answer your question.
Thank you, Gunjek. Let's have Remy. Remy, you're here. Let's just unmute yourself and speak.
Thank you very much, Ayola, and thank you guys for the session. My name is Remy Ajenifuja, and I am building Fronet. We are trying to solve the problem of lack of affordable uncapped Wi-Fi internet in small cities. Most internet in Nigeria is focused on the major cities, and Starlink came like 5 years ago, and in that time, because they have nationwide coverage, they've met up with the largest ISP. We are beating the cost to almost nothing so that we'll be able to scale to a much larger market and be the first ISP in Nigeria to reach 1 million users. Now, we have begun operation. We've built a pilot. We have high customer retentions, about 40 users that subscribe consistently for the past 12 months. We've been keeping P&L. We have our finance dashboard. The team is working. Right now, we don't pay the team. We have an arrears basis agreement with the team. So our team debt is climbing, and we are currently fundraising for a pre-seed, less than 100K. And of course, we've gotten interest from a few angels who do not exactly understand how angel investing works. Somebody offered to give us about $10,000 for 50% of the company. So we also have interest from a few VC we are in conversations only in due diligence with one person. We have data room ready. We've given a lot of data. We went through due diligence with one VC for 200K in January. After due diligence, they did not disburse funds. They just went silent. So right now, costs are climbing. We got AWS credits to offset costs. The credits are expiring this month. We have rent. We are trying to scale. Our system is CapEx heavy. So we need to get equipment before we can scale. And we need to scale before we can become capital revenue positive. We are trying to be capital efficient, but there's so much that you can cut if you cannot generate sufficient revenue. So we've done all of this. What's the way forward for a business like this, in this situation, in an ecosystem like this? Thank you.
Sure. Yeah, first of all, hi, Remy. And to be honest, it's really lovely to hear that you are already tracking your finances in such detail that you have financial dashboards, P&Ls, and everything in detail already prepared with you. And congratulations on that. That's the first thing. Secondly, I mean, the best way here is to understand, obviously, from the previous investment talks that you have had, is to understand what went wrong there. Obviously, because unless you don't know the problem, and we don't know the problem, it is really hard to reach at a solution. So, right, the problem can be anywhere. I mean, they can see that probably there is a problem in the business model. Investors can be of the opinion that there are other competitors maybe who are doing better. Investors can see like the financials that you are already preparing, and then you consider them to be on point, are not that accurate. So anything could be the problem, but it is really important to get a feedback on there. If you know anyone from all the previous conversations that you have with the investors that you just talk about, or if you are looking to go up to any investor now, please ask them to give you a feedback each time you guys are meeting on what they like, what they don't like, and how the things can go forward, right? Because yes, we have seen this a lot uh, that, for example, on behalf of a startup, I'm talking to a VC, an investor, and they just go silent. But when we specifically ask them to provide an input or a feedback on the business, they do come back. So I would definitely recommend you to do that if that's helpful.
All right, thanks, Gunjet. I don't know if you have any other question from the audience. You can just raise your hands. But I would ask you this question, right? As a founder, I've also worked across different startups over the years as well. But as a founder who is building out a startup, right? I'm speaking for the early stage, idea stage startup. What important role should I put in place when hiring? And I think that this is for all the founders on the call, right? I'm sure I'm speaking for them. What important role should I put my effort on when hiring?
Yeah, I agree.
Founder, maybe I'm a founder, maybe I'm technical or not technical, depending on the industry where I'm playing. Or I just have an idea, I have no experience in that industry, but the idea, I'm very sure my idea is great. I've tested it out, I've done my survey. When I need to put my team together, now, maybe not necessarily the co-founding team, but if you want to answer it from that angle, I'm happy to also hear that. What should I focus on?
I will take this first, and then I will let Gunjesh speak more around this.
Let me add a caveat there, Mansi.
Yeah.
Don't be
Yeah.
biased. Don't say finance.
I am not gonna be biased. I am gonna speak what I do for my business.
All right.
And I'm gonna speak in that way, right? And I believe that has worked for me, so must work for the other co-founders and other founders, fellow founders as well. When I started my company, I come from a background of working with different employers before this, right? And then I co-founded my company. So I knew the grass is never the greener on any end, not the founders, like not the employers end, not the employees end. To be really honest, the first thing that I see in anybody is the potential, even if they are not at the 100% mark of what I'm trying to find in one particular person. The potential and the dedication is something that I see into an employee when I look into it forward. But most of the founders do one simple mistake during this process. And that is they get very emotionally handled by the position that they are holding as the founder. If you feel the resourcing that you have done is not good and you want to change it, I believe do get rid of those people who are disturbing the culture of your organization as quickly as possible without thinking a lot if you have seen the kind of pattern of disturbance in your company. Sometimes it happens, it gets stretched so along that other like employees of your organization get very frustrated because of a certain resource that has been like hired wrongly by you, and not only it impacts their own performance but also the performance of the fellow teammates, right? So what I would say in that sense, be very neutral that okay, I, if needed, will get rid of anybody in the team that is not working for me. And also, I will hire somebody fast to fulfill what the requirement is. I am not saying be ruthless on your team and go like treat them like slaves. No, but I'm just trying to say that I have seen most of the companies where they have, because somebody was working with them for a few years, even if their performance eroded, or if they did not were similar kind of an asset for the company, it got so much stressed out. It started impacting the other employees as well, and it got in worse. So that's what I actually follow. And also, when you are hiring somebody, think about it in a way for every particular person that you hire, is whether or not you see a long term vision with that person, and how do you treat them to keep them in the company in that way.
All right.
That's how I like work around it. Gunjesh, if you want to add
I would
anything to this.
No, definitely. I mean, I would just like to extend this conversation on obviously, I mean, if I want to highlight like two or three most important aspects that we will see is obviously the cultural fit and alignment with the company's overall objective. Reason being, if so, for example, if you are a sustainability company, you are very passionate about environment, if you and you are doing like everything to keep I mean making the earth a better place to live, but the people that you're hiring does not even care if they are getting out of their cabins and not turning off the lights. How do you feel about that? So it is really important that people are culturally fit, they understand what the objective of the business is, and they align with that. And the second point that Mansi covers already is about their potential. Obviously, skills is important, but their potential and dedication is probably more important. And if they are dedicated and they have good potential, then you can definitely take the most out of that person. So yeah, that's my 2 cents on
All
this.
right. Thanks, Mansi and Gunjesh. I'm just going to ask another question that might be, of trouble to founders. Pardon me, I speak to founders every other day, right? How do I compensate for potentials and dedication? How do I compensate that doesn't affect my financials? For instance, how do I compensate you for your experience? I need a Gunjesh
Yeah.
on the team. I can't afford him. I've toasted him. Let me use the word toasted. He's agreed for a potential period of time. He will be there for some sweat equity, but it's not giving me the attention. How do I compensate in such a way that it balances out and it's not looking like I had an over-experienced person? I want to keep my books looking good for the investors over time. How do I balance all that? And how do you come into play with that entire conversation? Do the financial person have a bandwidth? Should I have a bandwidth of salaries? How do I determine what salaries should be when I'm at zero revenue for an early stage? I'm already making revenue. I want to be profitable. And how do I, calculate that, so that I have a bandwidth? How do I even pay myself? How do I determine how much I should be paid as a co-founder or founder?
Yeah, no, that's fantastic question, Ayula. And the point that I raised earlier, when we were speaking earlier, that valuing yourself and valuing your team is really very important, because those are the people that have stood with you when you don't have funds, when you don't have money, and when they were working for you just because they believe in you, right? They could have joined some other big company and something else, but obviously, people at a startup works when they actually believe that this idea is going to work and it is going to become the next big thing. So you have to value those people who are joining you at an early stage, maybe not immediately, and probably they'll understand. And that's where I was coming from when I was saying that if the person is actually passionate about what you're doing, if the person actually believes in the idea, if that person is actually culturally fit for the company, it is not like they'll immediately want 100K in salary. They can work obviously at a certain level of they can work at a minimum level of salary that they'll need to maintain their lifestyle. And along with that, if you are giving them equity, if you are valuing their work within the company, not just valuing them based on what their salary and what you expect them to do, rather actually giving them good appreciation, valuing their work, presenting them as a front end of your team. I think these non-financial matters also also is a very big component of payment when it comes to your core team, the team that joins you when nobody's there with you. So, I mean, that is really important, the non-financial aspects.
Right. Jude, you had your hands up. You want to quickly take the floor? Jude.
Yeah. Sorry. I was just trying to follow up on your question earlier and just to add a little bit of my concern on it. For founders, when you put in resources into an idea with the mindset that you have this idea and want it to grow, it comes with so much belief that this is going to work, and you have that fuel in you, you have that zeal, it's burning, right? And you need the resource personnel, you need the human resources to actually work with you on this journey. I'm talking from experience because when someone has invested over £5,000 or thereabout into a business, and you have some people because they claim to be in an ecosystem that is not as working as where you are, they tend to want to make you feel like, oh, this is not enough. It's never enough. And that is what I've learned in this few period of the startup thinking. It's never enough. So how do you, just like you asked the question, is it better to outsource at this point, or can you literally manage human resources? Because if you as a founder or as a business owner is not on ground, I feel that's another major problem. So I'm concerned, is outsourcing the best option at this early stage, rather than just going through the stress of managing people and every other resources of the ecosystem where the business is set up?
If I can quickly
Yeah, go ahead.
ask Jude, first of all, great question, Jude. If I can quickly ask one thing, what are you thinking to, which function of your business are you thinking to outsource?
So basically, I'm looking at outsourcing human resource and finance.
Okay.
Those are the two things I'm hearing, human resource and finance, because those are the major concerns where I have my bottlenecks now.
Okay. Gunjesh, do
Yeah.
you want to take it? I can also take it if you
Absolutely.
want to.
Yeah, no, happy to take it, and then you can add on your 2 cents. So, first of all, great question, Jude, and that is definitely very important for a founder to understand that what are the functions which are core to his business and what are the functions which are supplementary to the businesses, right? So, for example, if you're building a tech product, your tech team is a core team that you want to have in-house, everyone sitting together, sharing ideas, building the product actually. But when it comes to the supporting teams like finance, accounts, HR, or anything else that is needed in your business, those teams are not necessarily needed in your office all the time, sitting together, focusing on the business, at least on the early stage. So I would highly recommend to always keep your core team in-house, and at an early stage where you want to spend less on the additional admin operations, finance and HR functions, you can go for some agencies who can help you out in those things. So that's the only point that I want to say. Mansi, if you have anything to add.
I second by a thought, like similar thing I was about. That's why I asked you, like which portions of your business are you thinking to outsource? Because definitely you need to keep your core team intact in front of you, in your control. Other things can actually be managed and be done very, very easily. We are managing it through Intent as well. A lot of finances for a lot of startups here. So I believe all of this can actually be managed, but your core team should be in your control. And that needs all of your focus. So if we could answer your question correctly, Jude.
All right. Thank you.
Yeah, sorry, Ayola. Sorry. I'm sorry. I'm so sorry.
Jude,
So,
I would arrest you on this call.
I'm so sorry.
All right,
Would
go
you
ahead.
Please go ahead.
sorry guys, would you now say that for a service providing business, the core team should be a sales team and sales and marketing? Because I
Yeah.
am actually at the point of also outsourcing. I literally believe in outsourcing at this point for a Nigerian business startup. I believe so much in outsourcing. I'm literally, because I've had a couple of people that I claim and that claim to want to work with me closely. And after 3 months, I feel like we're just still stuck. And I'm always chasing after them. But I feel like if I had actually outsourced all of this role, right, I wouldn't be bothered. I would just be getting my reports and making decisions based on the reports. Do you understand? So it's a thank you for that. I really it's seriously annoying. I have to use that word. So I literally could outsource all the functionalities for all I care. But for me, now you're telling me that they're cool. I should put in some people close to me because they're my cool stuff. Yeah, but are you saying for a service providing business like mine, marketing and sales should not be outsourced?
All right. So, Jude, what I would say is that there's an intense partnership breakout room where you can have, an advisory on this. But to be very honest, it's not like we don't want to answer the question. I can see Neil saying, Neil saying, I can feel your pain. I think that, okay, no, Newman, I think that this is a general problem for founders.
Yeah.
But again, I want to move the mic a little bit faster to a lot of founders on this call. So I will take Emmanuel. Emmanuel, please, let's have you. Jude, I want to answer your question. I want your question to be answered. But again, there are still other sections of this conversation we want to also get into. So Emmanuel, let's have you. Jude, sorry. I'm so sorry. I'm honestly sorry, but I will do that.
All right, thank you.
Emmanuel.
All right, thank you so much for giving me audience. My name is Erim Emmanuel. I'm the founder of Dropout, an tech solution that seeks to connect lecturers and students across institutions in Africa. And all right, so we are currently the product is already live. Yeah, we have about 2,600 users already. Yeah, so though we are still we are pre-revenue stage because we rolled out um, a free version of the app, and then just to test the market and see and get some feedback. So by the grace of God, we've been able to get a lot of feedbacks, and then we are coming in with our updates in a week time that has a subscription model. All right, so right now I want to there's another brand that was in the same sector with us, Edukoya, that's the brand's name, that shut down I think some months back this year. That fully shut down some months back this year. So that company had got investment of about $3.5 million, $3.5 million, and then they operated for some years, I think about 2 years, and on the third year they decided to shut down completely. So and from my findings, I have reports that the company later returned the $3.5 million investment to the investors. So I want to look at their situation from the side of a brand that had financial discipline. So, and I want to ask if you, because you said earlier that most of the startups that get funding and shut down after a while, that majority of them have financial management issues. So I want to know if the case of this Brown is a financial issue when they were able to still refund. Was it an execution issue or accounting or bookkeeping issue for them because they were able to still return funds the exact amount back to the investors. So I want to understand because it's one of the issues that potential investors always raise to me whenever I approach them. They want to know how I will do things differently because we happen to be in the same sector. So that we'll know if it's truly a financial management issue or something else. Thank you.
Thank you, Emmanuel.
Yeah.
Great question.
Yeah, that's a great question.
Yeah.
Yeah, that's a great question, Emmanuel, and I can see where you're coming from. So to answer your question properly, let's see the two aspects of it. So, for example, you said that okay, because I was not keeping the books of accounts, is it a bad financial planning, and will I not? I mean my startup will go into loss and I'll not make money and I'll lose all the money. And will this happen? So the simple answer is no, it is not because of that. The complicated answer is because you won't be able to take the proper financial decisions that you have to take to run your business successfully and for doing that, you need the basic financial documents in hand. So, for example, if you have a proper cash flow forecast in your hand that shows you in coming months, how many, what amount is going to come in, what amount do I have to pay, what is my burn rate, what's my runway exactly. If you have that level of understanding, if you have that level of foresight of your business right away in front of you, then you can take a lot of decision, like do you have to stock something, do you have to clear the stock, should you give extra discounts to people to get your services or product, should you hire someone, should you fire someone. And these are the decisions that ultimately become crucial for your success. So that's the ultimate problem here. So it's not about keeping the books of accounts, it's about taking the financial decisions based on the numbers that you have. So that's I hope I was able to answer your question.
Okay, so let me just shed some more lights into what I think Emmanuel is also facing. Someone who was the biggest player in his market has shut down. Someone who used to be the yardstick of that market shut down. Someone who looked like it was a potential business with a lot of financial discipline, raised money till the stage where they raised, shut down. He's struggling with investors' trust, not necessarily because his product is not great. He's probably doing something different than the other guys. He's looked at their model, he's pivoted his model to a new idea. His revenue is coming in from, different models or different streams. The investors are kind of worried, even though the first player in the industry or the best in his industry or who was playing in that industry had the reputation to return the funds. There's still that skepticism that that investors are struggling with him. Beyond, he wants to know from the financial discipline standpoint, if I'm speaking for Emmanuel, based on what Mansi has said, that, they don't fail because of X, they fail because they lack financial discipline. If I lacked financial discipline, I shouldn't even be able to return investors' money, right? But now I've returned investors' money and I'm struggling. How do I move on?
Can I quickly
how do I prove to these investors that they can take the vote of confidence on me? I think that's his question as well.
So, just to answer your question and Emmanuel's as well, I work with a lot of fundraising rounds where I see that if there is one kind of a hamper done by a particular industry giant, the industry investors are a little bit skeptical and they get scared of putting their money into a same role. It has happened worldwide in different industries. It is happening right now in India in edtech as well, where Byju's, which was one of the biggest companies in India, which was in edtech, doomed very badly. And now the edtech industry is facing a lot of backlash for, even if they are doing phenomenal work, they're not getting a lot of fundraising from the investors. And why? Because their confidence is shaken in that particular by that particular bash that they have seen by the biggest player in the industry that there was. So I understand what Emmanuel is trying to say and what he was thinking about. The thing is, the only way to go around it is to present your story in a way which makes a little bit more which builds a little bit more confidence in the investors, and say it in a way that, okay, this is what I am doing different, this is how I plan to take the risk mitigation factors into account when I am moving in the same industry that I am working in. For example, if you are just saying that, okay, I have kept my books of accounts, these are my financials, my burnout rate is at a different level, but again, someday in future, after 4 years, I'm going to be profitable. If this industry is on a burn rate right now, investors would be skeptical to put money in similar kind of industries. That is something that we have seen over and over again with different industries as well, right? So what I believe is, find a way where you can actually tell your story more convincingly in a way how you present financials. There is a way how you can show your projections and reports, which can actually convince investors to believe that, okay, let's try and give out uh, a certain amount of money to this particular player as well. We believe that, okay, this can be a turnaround for them. And this has happened before as well. So this is what I believe. Also, if you feel that there is some kind of support that one might require to fulfill that kind of confidence, go ahead and do that is what I would suggest here. Gundesh, anything from your end that you would like to add in this situation?
So I think sometimes, so a lot of people talk about product market fit, but
Yeah,
like people not often talk about founder market fit or investor market fit. These
true that.
are
True
these
that.
are yeah, these are really, yeah, I mean, two very important concepts that we need to think about. So investor market fit, like for example, if there is a company, is a VC fund who invest in fintech, it is their core. Like they do all sorts of funding at all levels. They like your edtech idea. You take your edtech idea with them. They love the idea. They invest in you. You have got the investment. Now you're working great. You are doing even over par than how the other edtech startups are doing. But what eventually will happen is that they'll compare you with the fintech companies that they have, right? They'll compare you with that industry because obviously of you are one of the company in their portfolio. And because when compared to the fintech, if your financials are not up to the mark, if you are unable to give that level of reporting because it is not a necessity from your standpoint, that's where investor lose confidence and you don't basically they don't trust on you and all sorts of issues occur. So it is very important to understand that investor market fit and or investor founder match is also one of the concept that you need to take care of while seeking investments. It's just not like, okay, he's giving 100K, I need 100K, let's go ahead with that. That
Yeah.
usually not doesn't work.
All right, great, thanks. Let's have Ebuka. Ebuka, you can unmute, Ebuka.
Hi, good morning. Thank you very much. Thank you very much for this opportunity. My name is Ebuka Foji, and I I founded a company called JJC. We've not really gone so much, so nobody has heard of it yet. Um, Here's the issue I'm facing right now. I've done my market survey, and it's something that we've gotten so many positive feedback from it. But the thing is, we're trying to build our MVP. I'm currently working as a project manager, so I'm still on salary and I'm not earning too much at the moment. So I can't really afford to pay for a lot of things, right? And because I can't really afford to pay for them now, and I'm saving for it though, it's going to take a long time before I'll be able to achieve certain things to even start up the MVP itself. My co-founder is a software engineer, and he, keeps telling me about his limitations when it comes to funding, finances, to be able to afford certain things like APIs and stuff like that. A quick brief of JJC. JJC is a transportation directions app that help commuters, especially people who use public transportation, to find their way around the country or around wherever they are, right? I believe that nobody knows everywhere. Literally, nobody knows everywhere. You can't say you know how to get to everywhere in a state, let alone the whole country. So JJC is supposed to help people, right, who are new to environment to be able to navigate their way through public transportation, right? So all the documentations have been set and all that, but it's just the funding part, how to get this started, and that's where we are currently stuck at.
All right.
So, and another thing is trying to get people to help out. Most of these guys will want to be paid, and I can't afford it for now. I don't know. I really don't know what to do from here. I'm really stuck. Thank you.
All right, thank you, Ebuka. I think to just layer Ebuka's contribution, at what stage should I even go for fundraising? I think that's also one of the things that I want you, Gunjek, and Mansi should also put some light to for founders. Again, we're in Africa, right? The reality for us is not what is the reality in Silicon Valley or in other markets, right? We don't want to use this playbook, right? And that's what Umbrella is basically trying to do. Real African problem. This is a real African problem for Ebuka, right? And not only Ebuka, almost every other founder. I know how many jobs I had to do to build Umbrella, right? Working extra hours, just trying to raise extra funds from different sources, right? This is a real problem. At what stage? Because we also hear investors say, well, it's a great idea, but you've not generated, no, you don't even have one paying customer, right? Or at what stage should I even focus on revenue as a founder? Is it from the onset? Is it at the onset of the business? The idea is great. I've done my research. Is it at that stage I start focusing on revenue? I can't even focus on revenue like Ebuka because the product is not even built. I don't even have the resources for it. But they found, will an investor put money behind my ideas? I think this question I wanted to layer to Ebuka's own as well.
Yeah, I
Thank you very
mean,
much. All right.
yeah, I understand, Ebuka, your problem, and Ayula, thanks for putting light on it. But to be honest, it is a bitter truth, and not just in Africa, in the whole world, that when you are at the idea stage, it is the hardest stage to raise any funding. And I mean, people get even mugged when they try to raise at idea stage, because uh, friends and family or angel investors are like, okay, give me 25% of your company. I'm happy to put this much amount. And because we are passionate about that idea, we go ahead with that. That okay, at least my company will be sustained. Even if I can get this little money for 25% of the equity, my company will sustain. So, I mean, I understand this problem very well, and there is no right time for a company to raise investment. Obviously, whenever they need funds, is and subject to they have not taken bad financial decisions. They have taken all good financial decisions, and whenever they need fund, they should go out and raise funds. But the only problem is that it is nowadays really hard to raise funds at the idea stage companies. It is a bitter truth, not just in Africa, but in the world. But given that, I think what you should be doing, Ibuka, is there has to be a great pitch deck with you that explains very clearly on what's the problem, what's your solution, how you're going to make money in 3 years, 2 years, 5 years time, whatever the time that is needed. How much money do you need, and where do you going to invest it? If you have a very clear answer to these questions, and if you have a very good financial deck that clearly outlines, okay, these are my problems, these are my solutions, these are the questions, these are answer to those, then 50% of your problem is solved. Now the only thing that you have to do is to find a right investor who is passionate about this idea and who will fund you. And obviously, going to bigger VCs and like the biggest of the firms is not the correct way at this stage. Rather, going to friends and families and angel investors would help you a lot in that. So that's my understanding on this. Mansi or Avila, if you'd
Just
like to add
just
something.
adding last point to this. Be really cautious to who you reach out to, Ebuka, at the early stage. Reason being, when you are at your vulnerable worst, a lot of people try to like take even the singlest penny that you might have in your business just to get profit out of it. It is good to have facilitators for that. because they understand, like, for example, if there is somebody who is expert in doing fundraising rounds or who have a better connection of investors, etc., connect with them, tell them your idea. If they are convinced, like as Gunjesh said, your pitch deck, your financial models, your budgets and forecasts should be crystal clear what you want to reflect with your business, right? If that is in place, connect with facilitators who have a broader network of investors who will align with the vision that you have for your business, right? Once that is in place, definitely it would be a bit easier. There are different ways that you can fundraise. Definitely, that is another conversation for some other day. But there are different ways that one can raise money, and it will be all dependent upon how you want to raise that money, be it equity, how you want to take debt. There are different versions. Like, is there a conversion of your fundraise, etc.? 15,000 different things can happen around that, but that's a different conversation altogether. The only thing is be a little bit cautious at the early stage. That is only that I would add here.
All right, thank you very much. Let's have you, Newman.
Okay, good morning, guys. Thank you for the opportunity. My name is Newman Bobo, and I'm building Metro. So just the general overview of what Metro is all about. It's meant to help you, like, it's meant to make it super easy to like create events, share them, manage your RSVPs, and invite other people to your events, and also have them to chip in to like help the cost of things. So unlike other platforms that are more focused on the ticketing aspect, we are trying to like build like a community, a hub for people to like come and discover events and new experiences in their towns, in their different states and towns. So my question is this: you guys have already touched something like you guys have already touched it a bit, answering Ebuka's question, but I want to know, like, how do you actually evaluate your company? How do you like evaluate your company to the extent of when you're asking for funding, and yeah, and they want to like ask for percentage? Like, how do you like do that? How do you navigate that? So that you not end up in a situation where you give someone so much percentage of your company for so little funding, and also people that are working with. How do you also like
pay for their service?
Yeah, through the percentages and offer them equity, like in a way that you're not offering someone too much on the long run.
Yeah, no, obviously. And thanks, Newman, for introducing yourself and for the question. It is a really good question. There are two aspects to it. So when you are a company who is at the idea stage or a pre-revenue or very minimal revenue stage, generally the valuations depend on the qualitative aspects. So qualitative aspects includes basically which industry do you belong to, how innovative is your product, how big it can become, has it already become big in some other market like US, UK, or somewhere else? These are all the aspects that investors take in place, or basically you also have to take in place by valuing yourself on the qualitative aspects. And that is usually done at the pre-revenue and at seed stage. But obviously, when you grow beyond that, there are a lot of other things that you need to take care of. So there are different types of models that you have to take care of, like your cash flow forecast, your discount, they're doing discounting of that, your multiple of revenue, multiple of profits, multiple of EBITDA. It depends upon which industry do you belong to. But in your case, because you are pre-revenue, it will be very, very subjective, and it will completely be on the qualitative factors. So I mean, and you have to fight for your equity, even if it is like 0.25 or 0.5%, you should fight for it. So for example, if an investor is saying like, for 25,000, can you give me like 2% of the equity, or for $1 million, can you give me like 10% of your equity? And because you have the passion about that industry, and because you understand that no, this business can become big and can become even greater than that, then you should fight that no, I can't give 10%, I'll start with 6%. They'll say 8%, then you can say, and that's how the negotiations will happen, and the value will get determined itself. Nobody can tell you a number that this is the value of your business. It is based on your qualitative factors, how the industry is doing, and your negotiation.
All right.
So yeah.
So my question to Intense, right? Intent, right? My question is, beyond the fractional CFO functionality that you've told us about, do you also go into valuation, for founders? Do you go into conversations with VCs? Maybe just touch on some of the services that you offer founders on this call as well.
Absolutely. So, as I we also do a little bit more onto the advanced side. So, this usually who are right now sitting at a fractional CFO level here in Intent, chartered accountants, ACCs, CPAs, with at least a decade of an experience hand-holding the finance functions for a lot of startups and scale-ups globally. Now they can be the fractional CFOs, virtual CFOs for a lot of businesses, right? Providing any kind of reports to the investors or the board members, and doing any kind of financial modeling for your business, budgets and forecasts for your business, assessing the overall markets for you, the industry that you work on to, and implementing that on the models that you work on to. So all of this is actually done in Intent internally with the role of fractional CFO. So to answer your question, Ayoola, definitely all the things that you were talking about is right now being worked up with Intent here. So, yeah.
I think I saw a question in the chat box. I just want to be sure that it wasn't a question. Just a minute. All right, that's fine. So I have a question for you, Tim. And my question goes, what happens in 6 months or 12 months of running my business if I'm not making money and I'm bootstrapping? Should I record just the money that I'm putting in the business? No revenue is coming in. Should I just keep recording how much I'm putting in the business or how much I've raised for the business? Just keep recording that. And so of course I'm recording my expenses, I'm recording everything, but there's no profits coming in. Should I just do that as a founder? And then if I need money as a founder, just an idea stage founder or an MVP stage founder, and I need money, I'm going back to take some money that I put in the business because I'm putting some savings somewhere in that business. Should I also record what I took out? All right.
So to answer your question very simply and in just 3 letters, it is YES. So yes, you should be doing that. So every penny that you're putting into the business, every penny that you're taking out of the business should be recorded clearly, even if on Excel, on a very simple level, at a very basic level. You don't need company like Intent to do that for you. You don't need company like any other service provider to do that on your behalf. But when you're at a bootstrap stage, you don't have any revenue and you're building something, every penny that you're putting into your business, every penny that you're taking out should be recorded and must be recorded. They will basically become the base for your negotiations with the investor in the coming future to show that what you have actually invested in this business along with your time and your efforts. So yeah.
All right. So let me just throw another question, right? And this might just point lights why some founders might not be thinking about fractional CFOs, right? In Africa, finance is what you, I don't know if you can you hear me now?
Mansi, can you hear?
Yeah, can you hear me now? Can you hear me now? Sorry.
Yeah. Sorry, you got cut off for a minute.
All right, that's fine.
Yeah.
I was going to say that in Africa, finance is something that you keep secret, right? You don't show it to a third party except the third party is willing to invest in, right? So the question is, how does that work on the fractional side of things?
So I think the how it works is obviously, I mean, not just the finance. I mean, every detail that you receive from the founder of a company is very, very confidential. From our perspective, if I talk about it, that even the business model, the financial side of it, the technical side of it, everything is very, very confidential. We enter into NDAs, we enter into MOUs that drives everything. And I mean, that gives founders also the satisfaction that, okay, my information is not going out because we have entered a non-disclosure agreement with them. So not just the financial aspect of it, but because when we are involved with the company, we try and understand the technical aspect of it as well. So we try and keep things confidential in such a way. So obviously, I understand that finance is a sacred matter, is a personal matter for everyone, but obviously when you engage a finance professional, you have to hand over the things to him and trust on the process. So yeah, that's the only point I would like to highlight. Mansi?
Just like screen record that. The only thing is, whenever we enter or we start working with any of our clients, the first thing that we do is understand what their need is, give the proposal, and the third thing is always we sign a service agreement with an MOU and NDA in place. We are already GDPR compliant for data privacy in the European zones of the world, and we do similar things for the different parts of the nations or the globe as well. So, having said that, we understand how important and crucial it can be to maintain the data privacy, and we respect that as well. For that, we always have the data rooms in place, which are between the founders and ourselves. Whenever we are working on it, we have OneDrive protected with passwords and everything, which only comes to us via the founders, and we keep that really, really private with us. And we do not share outside the organization as well. And this is being followed everywhere in the world that we work. So, irrespective of the geography, I would say that is the practice that we follow in intent.
All right. So let me just ask another question that might be of interest. I don't know if any other founder wants to ask a question. You can just raise your hands, and we'll be happy to spotlight you on the conversation. So I also noticed that a lot of founders find it hard to pivot from premium, what we call free services, right? You at the very beginning of your idea, you offered everything for free. I heard somebody say that on this call as well, and we got people on the call. I think it was Ebuka, right? And now, I'm not speaking to Ebuka now, but generally, I think the question is, should I start my services for free, or I should focus on revenue from the onset, right? I know we're chasing numbers, you're chasing users, you're chasing some vanity metrics. Revenue is actually, I think, the metrics, but of course, I see a lot of startups struggle to move users from freemium to revenue, right? Are they financial advisory that you also give when starting out, one, or I've started out wrongly or rightly? Of course, getting the users to come on board is also very important. And after a while, I start to introduce my subscription service and the rest to them, But what's your advice? What's your take? And maybe what do you see in some structured environment that you've worked in, Mansi and Gunjesh, that you can maybe advise some founders on this call with respect to business model? I think I'm thinking about business model, yeah.
Absolutely. Absolutely. So I'm gonna quickly just say one or two points and then hand it over to Gundesh for further discussion. Um, the only thing is why premium is something which is very attractive to everybody is it gives two things. People love free stuff. And another thing is that creates a little bit of more confidence in the first few users when you are just starting off just to take off. You will have to invest a little bit with your premium users who are using your services or maybe your goods at that moment of time. And then slowly and steadily, you should have an understanding where we need to stop. And to answer your question correctly, Ayula, we do that kind of advisory services as well here in Intent, where we provide that kind of strategic help to the founders that, okay, this is the runway until unless you will be able to do this. After this point of time, you need to go into a certain different model, which becomes hybrid, and then you need to leave the parallel grounds ahead where you need to go from premium to a paid version model. So definitely we do that. Gunjesh, over to you for any further discussions around that.
No, I mean, I just wanted to highlight that. I mean, from my perspective and what I have learned, India as a nation and Africa as a continent has very similar economies, same population, a bit of the same mindset when it comes to finance and running businesses, etc. So, I mean, I have seen it very closely that in these sort of countries, it is very difficult to sell products on a subscription basis or on a premium basis where people sign up today and then they have to pay every month, every month, every month. So people do, so the actual customer that we want to target doesn't want to take that liability on the first day that, okay, I have to pay this every month, I need it. So, I mean, in these sort of countries and geographies, it is very difficult to launch a subscription model. And that's why a freemium model, so freemium, what does it mean? Is to start with free and then turn it into premium so that some features are obviously free that you're giving at the first site, and then you will slowly convert into premium. So I'll give you a very quick example, a very good example of an Indian company. It's called Zomato. It is if you have heard of DoorDash, it is the DoorDash of India. So how they started is basically they are a food delivery company. What they started to do is they raised funds, they built their product, they built the platform, they onboarded restaurants, and what they started doing is they didn't charge anything from the restaurant, and instead they started giving a lot of discounts to people who are ordering food. So for example, if you're ordering foods for like $10, you will get $2 of discount. So if you go to the shop and you eat something there, you will get it for $10. But if you sit at your home, order it on the website, you'll get it for $8 and with your convenient setup. So that's how they build it. That okay, they have invested a lot of money. They have put in like millions into giving people discounts and offers and free and everything of that sort. But that company is now listed in Indian Stock Exchange. That company is now making revenues of millions. That company has reached billions. It is a very big unicorn of India. Um, and how they have done that is then slowly, when the people got used to it and people got used to the convenience of ordering through that website, sitting in their home, then they started charging commissions on every order from the restaurant. They started charging the delivery charges on every order from people. So first they built the habit of that convenience, and then they started charging the premium for that. So obviously, it has worked for them because they had like millions to invest at the first instance. But I'm not saying that it will work for everyone, and that's where the advisory and consultancy comes in place. That depending upon your business model, you have to take that sort of decision. So I was just giving an example, but yeah, that's my general understanding of it. So yeah.
All right, Innocent, honestly, you can jump on the call and just speak, right? But Innocent asked, what is the ideal time frame to ease out into premium from freemium?
So I mean, so for example, I mean, it depends. I mean, we can take multiple examples for that. So right, for example, if you talk about YouTube, just take a very basic example of YouTube, right? So they are not a premium. So they are a premium and they are not a premium at the same time, right? So if you want to see ad-free videos, then you can opt for premium. So it depends that what you are giving customer additionally when you are charging premium for them. So if I don't want to see ads, then only I'll take the premium. Otherwise, I'll just watch at the free level. Similar thing goes with Spotify and other music platforms as well. So that, I mean, that depends on what model that you're focusing on. Like for a fintech company who facilitate payments, so if you want to make any, so if you want to make any payment from like individual to individual, you can keep it free. But then if there are merchants that got onboarded onto it, so when you're giving B2B services, you can charge premium from them. So you got promoted by offering your services to individuals who are not businesses, but now you are making money from businesses who wants to take the money using that platform from those individuals who already got addicted to your platform. So I mean, there are different ways of doing this, and there is no like, I mean, there's not obviously one answer to this because the business models will be so different for different people. But yeah, I was just giving a few examples to you.
All right, thanks very much for that input. So I just want you to also shed light to a baby. Let's just even assume that we have some founders on this call who are not used to some financial terminologies. What should I focus on as a founder if I have to raise money? What terminologies do I need to look into? MRR, ARR, FYY, HYY. You know, you financial people have all those terminologies. You get on calls and investors are also asking you some of these questions. As a first-time, founder, maybe, it was your first time jumping on the call and the investor is saying, what's your run rate? What's your burn rate? The guy is wondering, we don't speak that terminologies in my books. So how do I, know these things, right? But I want to believe that a bunch of the founders on this call even know what those things mean. If they've been in a lot of communities, they probably be hearing those conversations or following some startup news. But what should we focus on? And what signs do I know that my business is in an unhealthy financial state? What exactly points me to that unhealthy financial state? So I know if I should stop putting in my money as if I'm bootstrapping, or I shouldn't even go, or I should go out looking for the funds itself.
Okay. Yeah, no, I mean, both great questions. So to address your first question, that about the terminology, obviously it is difficult to understand. I mean, it is it is equal and difficult. So for example, if someone asks me that, okay, I am coding for a software and this is the language I'm putting in these codes, and okay,
Java,
so
Laravel.
yeah, exactly. So you see what I'm doing, and I'm like, okay, I don't know what you're doing, and I don't understand that. And I understand that obviously I can't expect a technical founder who is building a technical product for his company should understand what ARR means, what burn means, what run rate means, what cash flow means, what balance sheet means, and that's where fractional finance come in place. So obviously, what we want people to have is not just get their books ready, but also have visuals on how their business is doing. And we want to talk to people in a language that investor would expect them to speak in, right? So you are a founder, you know your product, you know everything, but when you go in front of investors, they are going to talk to you in technical language, but in financial language. So it's ultimately becomes your responsibility and your duty to understand and to know the financial language. And for that, you need, even for a fraction of an hour on a weekly basis or on a monthly basis, you need some financial person who can guide you on these terminology, who can let you know on how your business is performing, who can tell you what your burn is, who can tell you what your basically current ratio is, who can tell you what your quick ratio is, who can tell you how your cash flows look like. So that's the only solution, because you can't expect everyone to be expert in every field, and therefore you need professionals like myself, or IT professionals, or law professionals, or legal advisors, etc.
All right, thank you. Mansi, you want to say something, or you pass?
No, absolutely. Just adding to this, I absolutely understand. As Gunjesh said, and as I also presented, it feels like a foreign language. It feels like an alien language to a lot of people. The only thing is, people actually, it's not that they do not understand finance. They understand that, okay, this is something which is happening. Customers are coming more, and now this is how the rotation is going. Like, the only thing is, I do not know, okay, this is what the terminology is for this. I understand what the base is, but okay, this is what it is called. If I say that, okay, my customers are repeating on a day-to-day level, but there are some who are not coming because of certain reason in my organization, or not buying my product after 2 months or 3 months. That is called customer churnout rate. If somebody easily understands, or somebody tells somebody that, okay, this is what it is, how there is a churn between the customers, and once you understand that, it becomes really easy. And as Gunjesh said, there are like professionals like ourselves who can support you in this. We prepare data dashboards in a way which is so easy to understand for anybody. Even a child who is in school at this moment can actually understand that, okay, this is how the fluctuations are going around. I believe there is an anomaly in a particular period. I can see it visually, even if you do not understand numbers in Excel. That is our job. That is somebody at a finance level's job to do and ease out it for the founders to understand. So definitely, I think it is not something which is a rocket science for anybody for that matter, but it needs a little bit of time and understanding and patience from anybody's point of view to take some time out and understand what's happening in their business. That's
All right.
all.
So let's go to the second part of the question, which is what points me to the red flags that the business is going towards danger? What terminologies? Explain the terminologies. Is it the burn rate? Is it the run rate? What shows me that I'm almost going into danger? Because usually when you speak to some founders who have failed, right? But there's no failed founders. I am, startup didn't scale anymore, right? They tell you, oh, well, but we're making money. We're making a lot of money, so, but something just happened along the line, and, we just had to shut down. So what, as a founder who is not technical, who has outsourced to the CFOs, right, the fractional CFOs and likes, what should point me to saying that if we keep going at this rate, right, sometimes you might be making revenue from the customers, but maybe your profit margin is not even next to nothing, right? So again, it's not really about revenue from the customers, right? But I just need you guys to speak as the professionals on this call. I'm also, a baby in the finance industry, so it will not be right for me to speak.
No, absolutely. I'm happy to answer this question for you. So one of the biggest mistakes that I have seen in a lot of company, and not only in startups, but in very well settled businesses as well, is that they don't understand that which money should be invested in which direction. So, for example, the biggest mistake that you can make is utilizing the long-term money for your short-term needs, or your short-term money for your long-term needs. So for example, if you have taken out a loan from a bank, let's keep it very simple. Let's not go into equity. If you have taken a loan from a bank and you have told them that I have taken this loan to purchase inventory, to make payments to my vendors, and to make payments to my staff to run the business. You have taken out that loan. It is a short-term loan. That was the purpose of this loan. As soon as you take out that loan, you invest in buying a new machinery, which will definitely help you grow into your business. So it's not like you have done any sort of fraud or something. You have actually invested the money into the business. You have purchased a new machinery. The only problem is that that money was for short-term use, which you have now utilized in a long-term, regularly invested money. So your working capital problem still remains the same. You still need to purchase the inventory. You still need to make payment to the vendors. You still next month have to pay out your salaries, but you have already invested your extra cash into the machinery. So it's really important to understand that at what point I should be investing in capital assets and at what point I should be reducing my working capital. And that is the biggest mistake that a founder usually makes. And that's the one point that I wanted to highlight, because I have seen this, this is getting done in a lot of companies on a regular basis globally, not with respect to a specific sector or a specific geography, but this is a global mistake that people do. And that's where we come in place, that whenever you have a cash crunch, you see that, okay, my business is running up, as you mentioned, I have lots of assets, but I don't have the money to pay out to my employees next month. That's when you actually need advice on where to invest the money. Is it the right time for me to buy a new machinery when I'm burning this much? Is it the right time for me to invest in a tech team who will build this new product for me for my business growth when I'm even unable to pay the salaries of my existing employees? And that's where I think the major role of a fractional CFO or a finance professional comes into place.
I think you've touched on.
Just adding very quickly here, Ayula. There are key performance indexes which are placed when we actually work on the financials. Like, for example, gross margin, net margin, EBITDA margin, contribution margin. All of these tell you that how your business is working in the profit levels at different levels of your business, right? If these are the like bare minimum parameters, if you see some anomalies in these parameters itself, there is something bigger going on in different things which we need to focus on. It gives the idea right away. There are, for example, if I talk about balance sheet, there are a lot of ratios that we calculate when we prepare it. For example, debt equity ratio. For example, if we are talking about how much the percentage of debt is there as opposed to the equity, if that is not balanced, it will not make sense. How good is your current ratio? How is current liabilities looking as to your current assets, etc. Like there are a lot of parameters where we actually put in data while analysis of your basic statement. If one does not want to go into details and they just see into these KPIs, just see the dashboard, see these parameters for an overall overview, they will get the idea that, okay, this is something which is going wrong in my business. I need to find out what's happening in this particular period. Or for example, I need to find out what's happening in this particular expense zone where I need to lay more focus on. That is what we actually do when we analyze the financials in a better way. And it is done for every other model of financial statement that we prepare at our end. And any financial professional will be doing the same for you. So, yeah.
All right. So all right. Go check. Just before you go, so you can add this
okay.
down with what I want to say.
Okay.
I also see founders build financial dashboards, right? So a financial dashboard is built by a tech person, right? For the business, right? And he just does basic subscription money comes in. So we have a dashboard that shows the money without speaking to a financial advisory people like yourself, or a financial advisor like yourself. At what stage of building your dashboard, right? Whatever business, I want to believe that if it's technical, you have a dashboard to see the runnings of the business. It's a financial person. Does a financial person play a key role in that build? Or should they just leverage APIs to build that does the financial modeling for them, or financial recordings and the rest of it? Because I see that these are also some of the problems that you might have, right? A little mistake from the technical guy in what you call MRR or ARR, the business starts to record something entirely different, and that's what they keep to present. By the time the investors does the financial due diligence, the numbers are different. Then it looks like the founders have lied, right? How do you guys come into
Ayula will. Yeah.
So how do you guys come into All right.
Okay.
So,
No,
sorry,
no.
I'll just quickly take this one, Gunjesh, if that's okay, right?
Sure, sure.
So,
Yeah.
now is the case, Ayula, where finance professional like ourselves are building these dashboards for you guys. So there is no need to be a mediator of a technical person to work on this. I myself work on Power BI, Tableau, C++, etc., to work on these major dashboards that are created for businesses, right? Because I am coming from a professional background of accountancy and finance, I know my numbers. I know what the background of the business is. I know what is happening in their business. I can come back to the founder and ask questions which are very relevant, which I want to understand from them directly and build the system accordingly. So, to answer your question, now there is no need to be any presence of any other technical person. Now professionals like CAs and ACCAs, they themselves can actually build these dashboards, and they have the best understanding of your financials. They can guide you in any other way that the need be, and they can definitely put more light on what is happening in your business and in a very beautifully presented dashboard level. And whatever the requirement is for that matter for any business, if they want it really basic with Excel, that can be done. If they want a little bit more modified one with Power BI, that can be done. If they want something more automated on a daily basis, that can be done on data rails and systems like that as well. So everything is now possible, and we ourselves are doing it. So no need for any other person now to be involved there. Yeah.
Gunjesh.
No, I mean to touch base on the earlier question,
Yes.
the only point that I wanted to add, and I'm adding this because I understand that it could be crucial to some of the founders, wherein you said that could there be one indicator wherein you can think that you should be stop putting in money into your business, right?
Yeah.
So one of the things that comes to my mind is about looking at your unit economics. So understanding what unit economics is. So for example, if you are building a product and if you're building that product for $100, and if for any reason, after deducting your taxes and everything, if you are selling that for 90, which and that I'm talking it about on the gross level, excluding the admin expenses and everything else. If you are doing a gross loss on your unit economics for each individual quantity that you are selling out, then it is a very big red flag, because as many quantities that you will sell in your business going ahead will increase your loss eventually. So for every quantity, you are taking on more loss. And when you are in that position, you have to rethink about the model. You have to rethink that whether you should be going ahead with this or whether you should be putting more money into this, because for every unit that is getting sold, I'm making a loss onto it. So that's the first thing. Second thing on dashboard building, as you already said, so it is basically maths, like 1 plus 1 is obviously 2. Whether I'll calculate it, Mansi will do, or any technical person will do it. It's basic. It's important to understand the financial concept behind it, right? So when I talk about the KPIs, when I talk about the current ratio, the quick ratio, and different sorts of ratios, different sorts of growth rates, the person who has the knowledge of that should ideally build that. So that's the only point that I wanted to add. So yeah.
All right. Thank you. I don't know if you have any other questions in public. We will be moving to the partnership sectors, where people who are interested in, having conversations with interns can go into that room and have conversations with them. We will do that for maybe 30 minutes, and then we can call it a day. But I would just ask the last question. Now, these days, we have founders building in public, and then some founders building in private. What should we communicate financially, whether you're doing both of them, building in public or building in private?
Mansi, are you taking this one? No, okay. Yeah, sorry.
I
I
was
thought you
just
have
trying to unmute,
unmuted.
but you can go ahead. No worries.
Yeah. No, okay. So I mean, I would like to understand it in a bit deeper manner, Ayula. I mean, when
Okay,
you
so
say building in
building in
private and building
public
in,
means that at every stage in time, you're communicating your numbers, you're communicating your figures, you're communicating what you're doing, you're communicating X, you're communicating Y, you have these users, you've seen your growth rates. That's building in public. Everybody's aware of your numbers. Building in private means that somewhere your numbers are not, communicated to the public. However, I'm asking, what should you communicate financially?
Okay. Yeah. So it's important to understand what is the confidential information for your business before communicating anything out into the public, because then your competitors or some people from some other industry might take advantage of it. So that's the first thing to understand. Second thing to understand in this aspect is obviously at some stage when you reach some level, uh, it will be expected from you as a statutory requirement to communicate everything, like your audit reports and everything will be a public document, and everything everyone can go out and see them from government portals, etc. So there is obviously one thing that that you should be keeping in mind, that eventually no matter what you do, the company becomes public and everybody have an understanding on how your company is functioning. But at the earlier stage, even if you understand that what is confidential, what you should not tell, and what can go out public and will put a positive image onto your business, should can be communicated and should not be an issue for any business for that matter.
All right. I think to just add to what you've said is this is the essence of why we need to be financially disciplined from the very onset. Because at any stage in time, you will still communicate publicly. If you're thinking of becoming in the next unicorn or becoming the next Series A or Series B, you're still going to have to communicate. Or even being listed in IPO or secondary markets, you would still have to communicate your financial discipline. So I'll just move us to the breakout rooms so that we can just have a few people chat. And while that is happening, I would stop sharing my screen. Stop sharing my screen and bring back, I think, sorry, just a minute. Let me just quickly check where the breakout room was. I think I had given Kunjek. All right. While that's happening, I just introduce some of the things. And I hope that the founders have learned one or two things. All right, so I think the rooms are open now. So you can all just click to join a breakout room.
Haven't received the invite for the breakout room yet, Ayala.
You said what?
Haven't received the invite for the breakout room yet.
Oh, okay. Let me do that again.
I think Mansi, you can see it at the bottom when you can see all the options of participants in chat. There you can see breakout room. Once you click on that, you will see one deal room already created. So there are, I can see 5 people have already joined.
Got it. Joining.
Yeah, I'm joining that now. Yeah.
Hi, everyone.
Hi, everyone.
Hi.
All right. So it's an open room. I would leave this room to Mansi and Junjek. They just run you more into deeper conversation around the product, the services, what the fee is or what the charges is, can be private, or you can also send them an email. But this just conversations that, more private, more personal. Feel free as founders to share what you want to share. And then once this is done for 30 minutes. Each founder just, limited time so that they can also answer our questions. We stretch them with a bulk of the questions we've asked earlier. But, if you have personal questions, Jude, I know you had one, and Mansi has personally told you, let's take it offline. But if you also want to drag her here, please feel free to drag.
Sure. So, first of all, thank you so much for staying till the last and to hear from us. We are very grateful for everyone to be here. I'll quickly tell everybody very quickly, like, what are the service propositions that we have here in Intent, and what are the charge out rates, how we work around, and what will be it for you when we go through the umbrella route. So I'll just take a moment of yours to share my screen. Let me know if the screen is visible to you. Just a second. Let me know if the screen is visible to everyone.
Yes, it is.
So when we talk about our service proposal, there are three portions where we have divided our services. We have professionals at finance associate level, finance manager level, and finance lead level. Now, all of these are chartered accountants, ACCAs, CPAs, or CFAs, or MBA finance professionals who have worked on the international finances before and are very much experienced in working on the international finances. When I talk about the day-to-day work of any business, as I was talking about bookkeeping, payroll, etc., it can actually be done by finance associate. Finance associates are chartered accountants with at least 2 years kind of an experience working in the global startup ecosystem. They can actually help you in bookkeeping, payroll, BRS, payment run, day-to-day work of any finance function for that matter. When we talk about a little bit more onto the strategic end, there comes the finance manager. Now, these are CAs with at least 3 to 5 year kind of an experience, and they can help you strategically form your processes for system optimization, management reports preparation, data visualization, as we were talking with Ayula for dashboard creations, reporting dashboard development, maintenance, rerunning, troubleshooting, etc. This can all be done by finance manager. And then we have finance lead. That can be the virtual or fractional CFO for any business. These are CAs with at least a decade of an experience, handholding the finance function for that matter. They can actually help in, as I discussed before, valuations, financial due diligence, board reporting, investor reporting, modeling, forecasting, budgeting, preparation of pitches, preparation of pitch decks, or fundraising. Finance leads can actually do it. They can also represent your finance function in front of your board members or your investors for that matter, right? The best part about it is all of this is on a per day kind of a rate, charge out rate. And mostly any startup do not need it more than 2 to 3 days for maintaining their monthly work. So 2 to 3 days of finance associate can actually clear out all the finance needs in your organization. Whenever you need any kind of strategic help from finance manager or lead, you can just take a day or two of them and your work can be done rather than hiring somebody internally at a bigger cost. And because we are coming from Umbrella's end, we are more than happy to extend a particular discount to people who are coming through Umbrella to us. So definitely, that is something that we can always discuss. But these are the service propositions that we have right now in place. I would open the questions for anybody that they might have, and I'm going to stop sharing here for a moment.
All right. So let me ask the first question. I see per day, right?
Yeah.
So I need a financial service. Let's create a scenario, right? I'm an early stage founder. I have a couple of traction. I'm thinking fundraising. I need a financial associate to come in. I give you all the data that I have. I give you my access to my financials. You get it done in 2 to 3 days, and I don't need you for the rest of the month, is what I hear you say. I don't need you for another 2-3 months, unless maybe I need to make some adjustments here and there for the investor, right? Is that what you're saying to us?
So what we are trying to say is it is all up to your call. If you see that, okay, I need to manage my base finances, an associate can do my work for 2 days a month, happy to do and work on just 2 days with the finance associate. If you feel like next month I need somebody at a senior level or I do not require your service at all, This is again the call of the founders themselves. It is as flexible as it can get. Again, the day rates are put in place because we do not want to say that, okay, it is a monthly quotation that we are going to give our clients. No, it can get as smaller as it can get as smaller as a per hour rate as well, if that works for our clients, because sometimes it happens like the hourly charge out rate is more beneficial for our clients. So we get into that as well. For example, if there is any SaaS company, IT company, for them, a monthly rotation rate is more beneficial for them. So we do that for them in that extent where a monthly quotation is given to them. So we can get into any flexibility zone for the clients that we are purposing out to. And it is always the call of the founder whether or not they want to go ahead with us, whenever they want our service, and how they want. If they feel that, okay, now I'm going in front of investors, I would need financial models in place before that, right? So you do not need a finance manager all the time, like in your organization to do that. You can just call a finance manager and tell that, okay, I need this to be prepared. I think this is a day, 3 days or 4 days kind of work from scratch. And that's all. That's the only time that a finance manager will charge out of it. So it is all towards the founder's end, and every flexibility in the world is allowed to them for that. Sorry.
Sounds good. All right, let's have you, Innocent.
Okay, so can you guys hear me?
Yes, we can.
Yes.
Okay, two
we
things.
finally see your voice.
Hi, Ayo. So, thank you. First, I want to thank AY for the opportunity. It's actually a very great platform. Two things I want to say. The one is a comment, and the second one is a question. The first one is Mansi, I don't know if why this. I understand that this is an international product. I don't know if why this pricing were done, if some regions were put into consideration, and in two ways actually. I don't know if there is some kind of custom available custom pricing for founders, because you understand some of us are founders and we are trying to raise funds. We are trying to get investors on board. So we might not really have access to some kind of funding initially. And when I actually visited your site before you presented your pricing here. And ideally, what a founder would need is something that's your third pricing option, which, because that one has pitch deck and projections and all that, which is ideal for a founder. But the pricing, I don't know about that. So I don't know if you've considered this side of the world in that pricing aspect. And secondly, my second question is, when do you start charge? When do you start charging? Do you collect the informations that you need, which you will now be able to decide, okay, this is going to take 3 days, this is going to take 4 days to deliver? Or is it at the point you start interacting with the client, you start getting all the data, all the statements, all the informations, the raw data you need to do the work? That is when you start charging.
Okay. Love your questions, Innocent, by the way. So first, answering your first question, whether or not I've considered this part of the world while making the quotation that I've put up in the world. So this is true that these rates are for the US markets and for the UK market. But as I told, there will be slightly different charge out rates for anybody coming from the African state, because I am really passionate to work in the region, and also for Umbrella. Anybody coming through Umbrella will definitely have a different kind of charge out rate. So definitely that is something that we can discuss upon too, if we go ahead. Second thing that you asked was, when do we charge, right? So how usually we do the deals with our clients is, first of all, we have a call with them to understand what their requirement is. In that particular call, we understand that, okay, these are the requirements. This is what our proposal will be. We share the proposal with them that, okay, For our estimation, we believe this much amount of work will take these many days. These are subject to a buffer of 1 or 2 days. If we take less days, we will charge less. If we take more days, we'll let you know that, okay, a day or two will be extra taken for doing the particular work, right? When the work starts, before that, a service agreement is already signed between both the parties. So it remains very confidential. NDA is signed between for the data privacy, and everything is done in that way. Once the work is done, everything is signed off, everything is checked off. After that, once the work is done, we raise the invoice as per the actual time that we have put in place, which is around the proposal time that we have put before, right? So matter. And from that day, you are like anybody for that matter is liable to pay us after our services are done. So we do not charge on a upfront level. We only charge after we have delivered our services. So Innocent, if you have any further questions, do let me know. I'm happy to answer more for you.
Yeah, that's actually, I'm good. I'm good. Thank you very much.
All right.
All right. Thank you.
Thank you, everyone. I don't know if there are other questions. Gunjesh, do you want to add or subtract to what has been
All
said?
good from my side, yeah.
All right.
Jude, you had some question before, right?
Jude is muted.
Okay, no worries.
All right. I see some other people on this call. Frederick, Gera, Abimbola, Ebuka. If you guys also want to speak, maybe speak about your product and maybe what your financial needs are. That's also very important. They might just know the investor to connect you to as well. You never can tell. Considering that Intent is highly connected, to be very honest, especially in the US and UK markets. They have very strong connections there. We are happy to partner with them to ensure that the pricing is really very affordable. And I'll tell you something. Let me just even give you a story of what has happened to us at Umbrella as well. When we came out, just like every founder, we had what our pricing would be. We had done our projections, daily, I think it was $150. If you check our website right now, it's $13. Like, we had to leave $150 to come to the reality of the market, right? And when we did that, data informed us, right? So again, I'm sure a lot of things around data, pricing, and all that across the verticals that we operate would also be very important to put into place. But for us, when we started, for you to even get an investor matching, it goes for as high as $3,000, $4,000. We're offering that for next to nothing, $13, right, for a monthly charge. And we realized that because there are a lot of early stage startups in Africa, it would be very hard for them to be able to make that money out. I think it was Ebuka also speaking around the Spain. Was it Ebuka? Yeah, I think Ebuka. Yeah, speaking around, him trying to just get into the market. But of course, funds is a limitation for him to scale his ideas. And these are like the realities of the market. But one thing I want to assure you guys of is that Intent and Umbrella are passionate about working with founders till they get to the very end, right? To the very stage where even when you are at series funding or you become a unicorn, you can still outsource your financials, right? Is what we're saying to you on this call, right? We at Umbrella operate an Uber model, right? Fully remote. We don't have any liabilities. We also, have people we sublet to, right? Why? Because when you try to own everything, you can run into problems at the very early stage. We also had to sit down to look at what areas were critical to us. Currently, we are also thinking about sourcing our finance. So I'm also, like everyone on this call, going to also outsource our finance to Intent as well. And we're saying this not because we want you to feel good, but we would also communicate. We build in public, right? And that's why I asked the question to Gunjek. If you read some of my posts on LinkedIn earlier, we even communicated the numbers and data for this webinar. And we would also keep doing this because we believe that the ecosystem, the problem in Africa is actually data as well, right? So if we're able to put out a lot of data, we think that we will be able to get the right set of founders to raise itself. Very key is that it's a new direction, right? Because half the time your financial manager sits in the office, he's doing payrolls, he's doing payments to third parties, and you don't need him there every other day, right? You can actually just sublet these things to, you can automate that process of payroll and payment while you have the other things that are more functional being handled.
Absolutely. Like anything and everything that one might require, as I always say in finance, intent can definitely help you out. Anything of that sort where you feel that, okay, this is something I feel is a little bit more complex. I would like to be a little bit more relaxed in terms of how the finances are being handled. We are more than happy to take it for you. And anybody, if wants to connect with me over LinkedIn, I think I have shared the details with Ayodhya already around it. So feel free to connect with me over LinkedIn. I'm very active there. So definitely I will respond to all of your messages. And for any other details, feel free to connect with Intent whenever one feels like. And we are always happy to start working with you. Looking forward to it for sure. Ayula, you're on mute. I'm really sorry.
Sorry, in the absence of any other questions, I would just take us back to the Jude. Oh, Jude, we were looking for you. We're looking for you a minute ago, Jude. You're welcome. Just speak, please.
Sorry. I had to respond to something very quickly. I stepped off for a minute. Yes, so thank you for this opportunity, Ayola. I mean, it's nice to see people like minds. And earlier I was talking about outsource. I don't know if that was addressed already. I was talking about the need, well, of course, I want to be specific to what I'm doing, right? I want to see, we've talked about what to outsource or what not to outsource. I'm at the point where I have my proposals, I've got my business plan, I've done my market research, strategy, all of those things around the ecosystem where I want to operate. And I've actually engaged a couple of consultants who are on ground to see what is physically obtainable and what is not obtainable at the moment and how we can scale. I believe that it is very key for you to be intentional about the approach you want to go for a business at the early stage, so that in the long run, you don't find yourself dilly-dallying around strategies and what you want to do. However, having said that, I've always had the mindset of I never want to have a physical structure of my business. If I'm setting up one, which I'm trying to do now, I'd rather have like everybody do remote because I believe that is where the future is going to be in the long run. So having said that, outsourcing is what I want to do. I was asking the question to see if it's a very good way to go. So if I'm going to be outsourcing, is where I am right now, I need to test the market. And because I'm not on ground, I need to find people who can push my business or the idea to see. I need real-time feedback. Do you get? So how do I go about that? So that's where I am currently, if that makes any sense to anybody.
All right. Good question, Jude, there. The only thing is, to add to your point, I believe you can definitely outsource your marketing and sales team. The only thing is you'll have to be on top of it. Reason being, until unless you are pretty close to the market, until unless you understand what's happening in the market, what's not working, what is working, this is where the product will fall. This is how competitors are being viewed. This is how the customers are responding to a particular thing when being asked about. Until unless you have the grip of it, nobody else can actually make such kind of decisions for you. So even if you're outsourcing your marketing or sales function for that matter, you need to be in control of them and get the feedback as as crisp as possible and in a way you want to understand and perceive the market is what I would tell you. Because there can be functions which can be outsourced, but I have seen people who have outsourced this major function, but again, because they were not on the top of it, it fell very bad. So that is just out of my sheer experience that I'm sharing. But Gunjesh, if you feel something else needs to be added on this, feel free to do that.
No, I think I agree, and I think to some extent we covered this previously. That outsourcing is fine. Obviously there are risks associated with it, like confidentiality risks. So your data might get leaked because of the outsourced staff. You have to have a lot of confidence on where you are outsourcing and do they actually understand your business up to the up to the mark on how you want to present your business. Are they actually presenting your business in that manner only? So you have to be on top of that. Outsourcing sales is obviously sales and marketing are two different functions, right? So outsourcing sales is something that obviously you can think about, but outsourcing marketing is, it is very key that how you want to present yourself in market. And if your team is understanding that, then I think you are good to outsource. That's my take on this.
All right, let's have Gerard.
All right. Hi guys. Can you
Hi.
hear me?
Hi. Yes,
Yeah, thank you, Ayo, and thank you, team. It's been a lovely session. I just wanted to point out that first, I get many of these invites a couple of times, but nothing catches my interest as much as this has caught mine. So just very quickly, so I wouldn't, keep some of us here longer than they should. So my name is Gerard, the founder CEO of Red Pillar Group. Red Pillar Group has a group of payment companies. We operate a bank in Nigeria. We have a payment company in Canada and also another payment company in Nigeria. So that forms up the group. And together we make around 100K US dollars every month in revenue. And we're currently working on a product that, could shoot our revenue to over 500K, which will be launched by next month. Now, my question is this. We've never raised, we've always bootstrapped from very day one. And we have a team size of about, I think, 55, if I'm not mistaken, both home and abroad. And we've been bootstrapping, myself and my co-founder, Daniel, ever since we started in 2018, officially. Now, one of the challenges we've had in fundraising, we've never raised before, is they say you guys are no longer a startup. Look at the numbers you are doing. Look at how you've grown. And we understand that in the VC world, you must have that. You've raised pre-seed, you've raised seed. Like that journey must be there. So we don't have that journey. We just want to jump. People are saying like, "Come, you are a Series A company. If you're raising Series A, not seed, we can't offer you this number. We can link you up to so person." But those other people want to see, even if they've seen traction, they verified it, but they want to see that other investors have invested in us right from pre-seed. So we are saying now, okay, should we just want to take 100K, even 500K, even though it cannot do anything for us, literally, because the business is taking care of its expenses, its staffing, even everything in general. That's the current dilemma we are in. So I don't know if anyone here or you yourself has encountered companies who has faced similar challenges in the past of, trying to raise when they've never raised before, and then when they want to now raise, they are actually way above the usual threshold that investors would expect. Say they are a Series A or Series B.
I think before I let the professionals, thanks them, Gerard. Before I let the professionals speak, I think that there are two sides to this coin, right? There's the side where a lot of founders in Africa are going back to bootstrapping, and this is a potential problem ahead of bootstrapping, right? Like solely bootstrapping the company, this is a potential problem that you are experiencing firsthand, right? Because when I go on converse or in communities and I hear, the best way for a founder now is to bootstrap rather than take VC's money or take angel money. Sometimes it sounds very interesting. It sounds like a very good perspective because you're not giving out equity. You have 100% control of the business. But it gets to the time when the business where the business is bigger than the founder, right? And then you need to also now look for funds. So it's an interesting problem. I'm also very interested in seeing how Mansi and Gunjesh gets us all out of this mix. But I want to assure you that you get the best advice.
I have a counter question for Jera.
Is the
Jera,
counter.
are you making money? Are you in profit or you're in loss?
You're in profit.
You're in profit.
Yeah.
And how much money do you want to invest to get up to the 500K revenue in building this product?
In fact, interestingly, we wouldn't, instead of building the product, we already have, in-house engineers that are doing it, and it has not just gone live now. So where we actually need funds is in expansion, from a team expansion point of view, from a market point of view, and also going to new markets. We are incorporated in other countries, but we are not licensed there. So funds will be used to get licensed in those countries, so we can operate legally, and officially in those countries.
Okay. So it's not like you need funds to run the business. You need funds to grow it into the other markets, right? To extend your geographies.
Yes, that's correct.
Oh, okay, okay. No, that makes sense. And obviously, first of all, congratulations to you on building such a big and such a successful, profitable business for yourself and for your entire team. So big congratulations to everyone. And obviously, you and you're not the first one who are facing this problem. So what usually happens is when you are pre-seed, right, or you are at idea level, you don't have revenue, as we discussed in the call as well, that the valuation is usually based on the qualitative aspect. So when the valuation is on qualitative aspects, the valuation can be like anything. So you have built something revolutionary, and it can be like the valuation can be like millions. Because you don't have any base to calculate it. And whenever the next round happens, usually it is on top of what the existing valuation is. And that's how your valuation gets increased, 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 and increased. And by the time you get revenue of any sort, your valuation is like 50 times of your revenue, 25 times of your revenue. But with the problem, and I would not say this as a problem, but from investors' point of view, it is a problem that when you have some revenue, they will value your business based on your existing revenue and your existing profits, and they'll calculate a multiple which then they'll apply to your revenue and profits, and they say that, okay, this is the revenue that is the maximum that we can offer you, what your current revenue is. And we have faced these sort of issues. This is a common problem. This is a general problem. But then obviously there are some VCs, and I think the main issue here is to reach out to the right investors who will genuinely understand that what you're trying to do, who values your business, who values how you operate and how you have made this business so successful and so big. So I think it is about, again, the investor founder match or investor product match. So I think that's the thing, that's the key here, that you have to find the right investor. Definitely, we would love to connect with you. Afterwards, we can understand in a bit detailed way. We can definitely give you some connections of the investors who would be happy to invest in such a successful business. So yeah, I think that
Jala,
could be one of the things.
can I say something? Never ever feel that because you haven't raised any more fund and you are bootstrapped, it is some kind of a lacuna that you have in your business. No. Certain investors appreciate that you were capable enough individually to like take your build up startup to a certain level by yourself, even if it is built by 2018. By technicality, a startup is a 7 year kind of startup which has run for good 7 years. That is a technical definition of startup. But investors are very much interested in passionate founders who have run their business very ethically and in a proper formatted way, then they are profitable, they have a good model in place. They love to talk with investors who have like something on a bootstrap level, because they have shown the caliber as their themselves and the founders themselves as well. So do not think in a way that because you have not raised funds before, that is something wrong. But there is eventually a time where you feel that your business is mature enough to raise funds now, and you need any kind of funding support now. So again, that is your call. Whenever you feel that, okay, now is the time that I need external people in my company to invest and then take it forward to another level globally, for example. So definitely, I would say you can connect with us. We'll be more than happy to support you in whatever capacity you feel like, and take it forward from there. So yeah.
I'm happy with the conversation. Gerard, do you want to quickly come back and give your candid like if you were satisfied with the feedback or you want them to go a little bit deeper, we're happy to also entertain it. It's the day room. Nothing should skip you in this room, to be very honest. But Jude says he has a thought on the current concern. Every idea is also welcome. So Jude, let's have you as well if you also have a direction to this conversation.
Yeah, sorry, very quickly again. Just I don't know how possible this is. I mean, if investors are concerned that your business is already looking way above what you where you seem to be. Say, for example, you can't be from the beginning anymore based on the profit you are turning in. I feel like they're scared. And, where someone is concerned that, they don't have the power from the ground, they might not want to get all in. They want to feel like they have a certain level of control from the beginning. If this new product can be registered or seen as a new business, could it not be a way to get them in a new business rather than a new product under an existing business? Just a thought. I don't know if that makes any sense.
Gerard, do you want to speak?
Sorry, I
Did you say
didn't
one?
get the question. My
Sorry,
line of
Jara, please go ahead.
Okay, so what you were saying is that this new product that you want to launch, right, or that you want to get into the market, rather than the big company who has been doing well over time, is it possible that you make the new product like a new startup, and then that guy gets the money, but of course the parent company maybe owns the products that you're pushing out, or the startup that you pushed out, and that way you can show record of having, if that's the problem, that way you can show record of having raised from a smaller company, and then the big company now wants to raise. That's what Jude's advice was to you. So I wanted you to just speak that if that's a direction that you think will work, or what are the limitations to that direction? Because we're all learning, we're all founders learning here. And it's great that you shared your own concerns.
Yeah, it's very valid. It's something we can explore. We've never thought about it anyway. Something we can explore. But to give you a bit of insight about this product, it's a core banking solution, targeted at fintechs and of course other financial institutions where they can manage their customers' accounts. It's very much regulatory compliance according to the standards of a country's policy. So we can explore that. I will just speak with my team internally and see if that's something we can do. But yeah, I think I get the perspective. I get his perspective.
All right. So from a professional standpoint, I also want to ask Mansi and Gunjesh, what are the negative of doing that, or what are the likely limitations of doing that? How does he also bring this product back to the mother company, and then the mother company also now has the opportunity to raise? I think that would also be a concern that I would also want to put some light, so that when Jera is speaking to his team, he's also speaking to them from a place of knowledge around
Yeah,
how.
no, actually, I was evaluating the option that Jude suggested as well. And thank you for doing that, Jude. I think the couple of problems that the investors might raise in that, or maybe could be an issue, is obviously because Jera has already told that this product is not incurring any explicit cost as such because the engineering team is in-house. So there is no additional cash outflow when we talk about it. Obviously, the team's efforts and times are there that we have to take into account, but there are no additional cash outflows. So that could be one of the things that if we are using the existing teams and if we don't need the funds for building the product, then shifting the product to building into a new company probably won't solve the problem, because the problem originally is to expand into new geographies and to get the compliance for those new areas. So I think that could be the only potential problem. The other thing could be because now Joera has said that they are building a core banking solution for fintech companies, and the existing company, I believe, must already be regulated in Nigeria and in the US, Joera. So if the company is already regulated, and if we set up a new company to get that
Get a new
regulated
license.
and using their software, that would probably be a very complex process because of the regulatory framework in every country. So that could be some of the
Limitation.
problems. But definitely, it is a very big conversation to have, and we need to consider a lot of aspects depending on how the current business model is, what the future looks like, what are the countries that we are looking to expand into, who could be the potential investors that would be, interested in such sort of activities, depending upon geography, nature of business, etc. So, would love to discuss in detail with you, Jera, whenever you have some time to reach out to us, and we can discuss in detail.
All right, so just to add, I will be sending in the presentations, the contact details to Intent, Mansi and Gunjesh, their emails. At Umbrella, we're very happy to do these introductions to all the founders on this call, and even the guys that didn't join the call as well. We would also do the introductions to them. We had well over 94 people who indicated interest to join this call. And I'm very happy that, Gerard said that he had gotten some benefit of this call. It's not a perspire to aspire kind of conversation or aspire to perspire. I also have my own, conversations around the industry and the aspire to perspire bit of it. But what we want to achieve with Umbrella Saturday is very, very different. Honest conversations, real life scenarios, life solving situations, so that founders can learn from founders. To be very honest, I didn't even think about the Jude perspective. I didn't even know that Bootstrap, because I also have been bootstrapping Umbrella, right? And I have a similar problem, right? The VCs sees us as competitions. We see the VCs as partners. The VCs in Africa will tell you, oh, we're doing the similar thing you're doing. So why should we come and partner with you guys? Why don't we? You guys are our competitors, right? Up till yesterday, a VC group that I belong to removed me off all the groups that they had because, they felt like I was a strong competitor, right? For me, it just says that the market is there. The opportunities to grow and scale is also still there. With time, maybe they'll start to understand what we are building for, which basically just makes us a verified pipeline. We're happy to have everybody on this call have all the information like I mentioned. So for Gerard, you're doing a great job. Like, I would love to know what the product is. I'm going to go check your details out again. And I would also like to do some introductions on behalf of you to some of the VCs that we have in our network. I don't think that what you face is also to tell you that there's an opportunity ahead of you. So limitations, if you didn't face any limitation and it was smooth, I would tell you that maybe the problem you're trying to solve, or what you're trying to raise money for necessarily is not of interest to anyone, but you have proof of test of products that your product is necessary. And so that way, I want to tell you congratulations ahead of time. Anything Mansi and Gunjesh says they will do, they do it all well, right? So I want to tell you that they will go the extra length for you on this. And then hopefully when you close the deal, it's a win-win situation for every party on this call and everybody in the community as well that's joined. I will close this group so we can go to the main group, and then so we can just close out this entire session. And it's been great having the rest of you on this call. At the beginning of this call, we were like 23, 24. We've lost a couple of people due to time. Founders are very important people. We wanted to capture Saturdays when you are on the bed. I want to believe that you're on your bed, legs up, resting and just listening in, or you're driving, less work, less stress, honest conversations around how you had the week, and then you're just coming to learn how you can also take your product to the next level. We'll have investors on these calls at times. As time goes on, we'll also bring in a couple of providers, right? And if, as a founder, if you also think that your product is also of benefit to the African ecosystem, it's also an opportunity for you to come as well. And then we can have a session with you on one of the Saturdays where you're also speaking about your product, about how your product grows, and solving some, challenges that some founders also face, and then an opportunity for you to upsell and cross-sell. So the room closes now, and then we just get into the main group. We have a group called the African Founders Community, AFC, also powered by Umbrella. So if you want to join the community, it's a free community. Less conversations in the community, to be very honest. The community is just so that founders can be together. You can share your problems. You can speak around anything. You can ask for introductions. You can ask for partnerships. On this chat room, I've seen some people even having conversations around taking off something off this group. And that's what I want to see in Africa. Collaborations, right? Rather than building in silos, right? It's also very great to partner and collaborate. We'll bring this session to an end. My name again is Ayola Oguyomi, CEO, co-founder of Umbrella. And my lovely speakers, Mansi and Gunjesh, did a lovely one to this first session, our first outing of Umbrella Saturday. When we wanted to start, it was just an idea, right? But it was born out of data, right? I've been in a lot of communities, right? And I see that those communities are not really doing the actual conversations that are important to founders. It's about the buzz, it's about the personalities, it's about clash of interest. For me, it's not about that for us. For Umbrella as a company, we're all inclusive. That's our company culture. We're agile, we are lean, and then we also are towards learning. And this is a part for us that is very important, learning, where everybody within the ecosystem can learn. And we'll extend this, as time goes on to the Portuguese-speaking countries and the French-speaking countries. So we would have translators at least set up to be able to translate for the Anglophone speaking countries, just in case the person who needs to speak is Portuguese or a French speaking person, so that we can all just learn from different perspectives, different cultures, different angles. If Mansi comes on this call next time and she wants to speak in a language, we should welcome it because that's who she is, and that's what we're saying at Umbrella. Africa is a very large continent to speak to. All right, thank you very much and have a lovely rest of your day. You can all mute your mics and just say hi to us for those who have been on the call for the longest.
Thank you so much, everyone, for joining today and staying till the last. Thank you so much for your patience as well for today's call. I will see you next time very, very soon, and hopefully talk on another Umbrella Saturday from there.
All right, no problem.
Bye, guys.
Bye.
Thank you so much. Bye.